Hello everyone, welcome you all to this very unique session on Super 100 questions of CA Final Financial Reporting new course. I have nitpicked, identified 100 odd questions from the study material RTP, MTP, including the recent ones and even the past exam questions, which either I found out to be most likely to be asked in the exams or those questions which have some tricky points and merit a last minute discussion. None of these questions are new questions. These are all identified already existing from the already existing material of the institute. But the idea is basically to have one question bank which we could possibly or we would possibly want to refer in the last week at the time once we have done the complete course to quickly skim through and ensure that all the critical questions we have kind of quickly covered through. You can take a printout of it if you want, or you can download it from the VAS website or the Telegram channel, links in the description. I'll also try to share the timestamps of various chapters which I have covered. This is basically the sequence which you are going to follow. First, we'll be starting with financial instruments, and then we'll be first covering the major chapters in this particular video. I will basically cover Schedule 3 in AS 1, Consolidated Financial Statement Business Combination, and Share-Based Payments. The way we are going to discuss these particular things would primarily and essentially be a quick recap of these questions, pointing out which areas you will have to focus upon to ensure that you don't miss out on those points. I will also be focusing upon the presentation which is required to be done because this video objective absolutely is to cover things purely from the exam point of view and ensure that we get maximum marks out of it. For the benefit of all the students and based on specific requests we've got, this will be in pure English. I'll try my best to the extent of my vocabulary permits for that. And because we took an FR Power batch, I also committed the student that will be coming out with something kind of a unique question revision. This is something which is it. Is this the same as the set of questions which we had given the FR Power batch? It's a subset of it. FR Power, we had used a question bank which was Super 400 kind of a, which covers almost all your important questions. This is most important and the tricky ones. Starting first with financial instrument, the first question basically talks about amortized cost method compound financial instrument. Financial instrument, one of the very commonly asked, repetitively asked institute favorite topic is compound financial instrument. This question, every question what I've done is I've tried to give you a heading so that while you revise you are clear what this particular question is all about. As the name suggests, it's a question about compound financial instrument, which means that in this case, there is a convertible kind of an instrument with some kind of a mandatory interest, and the interest portion will be your liability portion and the principal portion will be your equity portion. Plus, on top of it, there are some transaction costs. Conceptually, those transaction costs need to be divided and segregated, split between the equity component and the liability component in proportion of their initial recognition values. So question says you have issued 10,000 compulsorily convertible preference shares on 1st April 2001 of 150 each. The rate of dividend is 10% mandatorily payable every year. The preference shares are convertible into 5,000 equity shares of the company at the end of 5th year from the date of allotment. Absolutely clear that the principal component is equity, whereas the interest being mandatory in nature would be a liability component. There's an obligation to pay. When they were issued, similar instrument at 15%. So that means by giving the conversion option, you've basically saved on some interest. So we will use this as the market interest rate as the base rate. Had there been no transaction cost, this would have been the effective interest rate. But because of transaction cost, this needs to be recomputed. It says transaction cost is 2% of the value of the proceed, which is 10,000 into 150, which would be 15 lakhs. So 15 lakh, 2% transaction cost, 30,000, 10% is actually the outflow every year, which you have to do 15% of the market rate of interest. Step one, what you do is you first calculate what are going to be your cash outflows. In this case, it will be 1,50,000 for 5 years. You will take the annuity factor discounting the market rate of interest using the market rate of interest of 15% and get the present value which will come to 5,02,823. Whereas you have actually received 15 lakh bucks, the difference basically would be for the equity component. In this particular proportion, you will have to split the transaction cost of 30,000. And once you do that, you will be able to understand that the liability component gets allocation of 10,056 rupees of transaction cost. Now we know initially we recognize financial liability at the fair value plus minus transaction cost. Transaction cost usually would be deducted because you will have to pay it out of your pocket. So that is the amount of money which you basically raise and return. So it is netted off. Hence your net liability would then be 502,823 minus 100,056. In order to ensure that your future 1,50,000 rupees payment for next 5 years discount to 502,823 minus 100,056, you will have to recompute an effective interest rate, because by discounting it at 15%, you will get 502,823. I want to get a little lesser than this, so I'll have to increase my effective interest rate. And for this effective interest rate, usually in such questions, the institute and the question itself would give you the effective interest rate. So in this case, they have not given, but then there is a similar question which has been again asked in either of the RTP or MTP, where they have given this particular figure in the question itself. So 15.86% is the present value. Initial liability would be 492,767, which is 502 minus 10,000, which will come to 492. And then 15.86% is the effective interest rate. You will create a financial liability amortization table, adding interest expense with this amount and the cash flow with 1,50,000. Finally, at the end of 5th year, you'll get 0. This is your financial liability component. Coming on to the equity component, the transaction cost which has been allocated to the equity part will be adjusted from reserve, for the simple reason that any cost incurred with respect to raising of equity is directly adjusted from reserves and will not go to P&L. Accordingly, these are the set of journal entries which you will have to pass. You can go through them once. Next. XYZ Limited is a company incorporated in India. It provides 10 lakh interest-free loan to its wholly owned subsidiary ABC. Now, these are of late very common questions between the group companies, wherein the parent provides interest-free or lesser concessional interest rate loans to subsidiary. In the July 21 also, there was a similar question that was with respect to employees. In this case, I have given a 10 lakh rupees interest-free loan to a wholly owned subsidiary, and there are no transaction costs. Thank you. How should the loan be accounted for in India's financial statement of XYZ parent, ABC subsidiary, and consolidated financial statements of the group? So they basically want you to tell accounting in all the three possible statements: one SFS of parent, CFS of parent, and standalone financial statement of subsidiary. However, they are giving you different scenarios under which you will have to report this. First is loan is repayable on demand. Now, if the loan is repayable on demand, the basic rule is that the one who borrows in no case will, or the one who gives in no case would, consider the fair value to be lesser than the face value. So in that case, it will be a very simple, clear-cut discussion. In separate financial statement of parent, the loan would be recognized at 10 lakh, liability of 10 lakh in subsidiary books consolidated, it would get netted off and it would not get any recognition. So in this particular case, we can simply say that fair value will be equal to cash consideration given. That's about it. The more interesting part would be the second one, where it says the loan is repayable after 3 years. Current market interest rate is 10% per annum for both holding and subsidiary. That means what you have given is not, or the contract which you have done is not at fair value. In such case, we use the market rate of interest, discount the future cash flows which we are expecting to receive with the market rate of interest to calculate the year 0 fair value. In this case, we will discount 10 lakh with 10%. For 3 years, we'll get the present value, which will be lesser than 10 lakh rupees. The difference is something which is an extra benefit which the parent is giving to subsidiary. The logic is that there would be a third party who would have requested us to give a loan today and would have promised to pay 10 lakh rupees after 3 years. We would not have given him 10 lakh rupees today. We would have given 10 lakh present value of 10 lakh rupees today. So what is the amount which we would have given? If we discount that particular value, it comes to 751,315. However, we have paid 10 lakh rupees, which means that we have actually given a benefit to the subsidiary of 248,685, which will be in the parent's book shown as investment in subsidiary. In the subsidiary books, it will be shown as equity under other equity. So in the parent financial statement, this would be accounted for as loan at fair value. And this would be deemed investment capital contribution in ABC Limited. You can simply put it investment. What is more important is if you want to be on the safer side, just try to match even the account names with what the institute has used. Then what you will do is you will have to recognize interest income at the rate of 10% for every year using compounding effect. So this would be 75131, and then on the total value this, and finally 10 lakh rupees is what you will receive after 3 years. In the books of subsidiary, again, subsidiary also will recognize financial liability at fair value 751. The benefit which it has got, it is got it from the parent company and it is treated as equity. So deemed capital contribution and will form part of other equity. Then it will have to book interest expense at effective interest rate of 10%, and then finally it pays 10 lakh rupees, comes out to zero. What happens in consolidated financial statement essentially, so these will essentially get knocked off. So it will have no impact because this is intra-group transactions. Now coming on to the third scenario, which is that, and this is something which you need to be clear about, the loan is repayable when ABC has funds to repay the loan. And please be very, very clear about this particular adjustment. What it means, it does not mean that the loan is repayable on demand. I give you some money and I say, you pay me whenever you want. And I say I will take it whenever I want. The former one is case C. The latter one is case A. I will take it whenever I want is demand loan. In that case, we will not recognize it below face value. But if I say you pay me whenever you have funds to repay, it means that you have the choice to decide as to when do you pay. In this case, I'll have to create an estimate as to when do I expect to receive this money. And then based on that particular estimation of my cash flows, I'll have to then discount it with the market rate of 10% credit, calculate the present value. The difference will be treated as investment and equity in the books of parent and subsidiary. In consolidated, it will get knocked off. So they've just given an explanation here, explaining in terms of what you'll have to do. You'll have to basically do an estimation, and then based on that, you'll have to do your calculation. If you estimate to recover it in 3 years, then the calculation would be similar to B, is what they have illustrated here. Then we have another question on modification accounting, one of the other very commonly asked and institute's favorite questions. In fact, in July 21, the question which was there was relating to financial asset modification. In this case, question says 1st January XYZ issues 10-year bonds for 10 lakh bearing interest at 10% payable annually on 31st December every year. So this is calendar year. The bonds are redeemable on 31st December 2009, which means 10 years from now, for 10 lakh, which is at par. There are no cost incurred, effective interest rate hence is 10%. After 5 years, bondholders agree to a modification based on which there will be no further interest payments which will be made. The bond will be redeemed on the original due date itself, but would be redeemed at 16 lakh, and there would be these legal and other fees involved. Whenever you get a question like this, first and foremost, prepare your mind to understand from whose viewpoint is this question asked. So obviously what we do is when we get a question, we first get into, which standard does it relate to. So it's purely financial instrument. Then I understand whether it's a question of taking a loan or giving a loan, a financial liability or a financial asset. So I understand it is accounting for the company who's issued bonds, it's a financial liability. Then I understand after 5 years there's a modification in this liability. So my hard disk then kind of quickly rotates and it takes me to the concepts of modification, which basically says that in case of financial liability, you need to first assess whether the modification is a substantial modification or not. In case if it is a substantial modification, in such situations, we will consider derecognition of the existing loan and recognition of a fresh loan. Which essentially means that we will basically say that we've paid off the old loan and we have recognized a new loan, wherein we will use the current market rates of interest to discount the future cash flows, and then we'll calculate the present value. In this case, the transaction cost goes to P&L, assuming that it relates to the previous loan's repayment. However, the modification is not substantial. In that situation, we would simply adjust the effective interest rate, saying that whatever changes I've done will effectively change our interest rate. How do I identify whether it's a substantial modification or not? I basically see that the revised cash flows in comparison to the previous cash flows present value, do they change by more than 10%? If yes, substantial modification. If no, not substantial modification. In this, it's very important to remember that transaction cost which you've incurred would also be considered under the revised cash flows, under the revised arrangements, to identify the different percentage. Now, if I essentially see here, I would now be paying 16 lakh plus I have incurred 50,000 rupees now, because the effective interest rate and the coupon rate were same. 1st January 2005, my carrying amount of loan would be 5 lakh, 10 lakh in fact. Now what I'll have to do is compare this carrying amount with the revised cash flows, which is 16 lakh after 5 years discounted at 10%. Plus 40,000 rupees which I have to pay today. So based on, is it for 50,000 bucks, sorry. So what we'll do is 16 lakh present value for 5 years plus 50,000 Now they calculate this value to be 10,43,474. Now, if I compare this with the carrying amount of 10 lakh, the difference is 4%, which is less than 10%. Hence, there is no substantial modification. So, I would simply say that this 40,000 which I have paid, I'll say that I have paid the liability. So, my liability would be reduced by 40,000. So, it will come to 9,60,000. In fact, I'm saying 40,000 and 50,000. So, 9,50,000 would be the revised liability. And I'll change my effective interest rate so that it equates to a future value of 16 lakh rupees. So liability would come to 950 and I'll have to equate 16 lakh after 5 years, present value coming to 9 lakh 50, which will increase my effective interest rate to 10.99%. Essentially, in this case, I would now henceforth charge interest using this 10.99% interest rate. There is a similar question in the module in which they have given everything similar to this except that the legal cost incurred have become 1 lakh rupees. Now, son, as I do that, it could possibly happen that the difference in that particular case may go beyond 10% criteria, and if that happens, then in that case it will be a substantial modification. It will become a different question. Anyways, we are not revising the concept. The idea is basically to handle this particular question. Derivative related question says entity A, INR is the functional currency, enters into a 1 million sale contract on 1st January 2001 with entity B, again INR being functional currency, to sell equipment on 30th June 2001. Another question which is very probable, not that it's been asked very regularly in the exam, but that is why possibly it could come now in the exam. If institute in December decides to have a paper for FR which breaks the trend in terms of what they've been asking all this while, do we expect something like that? Honestly speaking, nobody can do any kind of an estimation, but I would strongly recommend that the time has come that we should be prepared for any surprises in the paper of FR. Derivatives. In this case, why there is a derivative? Please understand this. I'll just spend a minute on the concept of this particular question. I am in India, you are in India, we are transacting anything, then we should transact ideally in Gandhiji, I mean in INRs only. I mean if you are buying the lectures. So you say that, say for example, you decide that, okay, so you say that, okay, so I want to take your financial reporting or audit fast track batch. I say, okay, that's let's say 7,500 bucks. And you say, okay, fine, I'll give you 7,500 and that's about it. But then I say, let's do some tufani, kuch tufani karte hain. I say, I will give you my lectures at $100. And you say, I mean, why $100? I mean, let's do something new, something different. I mean, so you say, okay, that's fine. Are you going to pay me in $100? No. Am I going to actually receive dollars from you? No. But then we've still done this transaction in dollars. Why? The reason is that possibly I am thinking that dollars will actually go higher, and that is why, since dollar will become dearer, I'll make more money on this because you will give me $100. Maybe you are thinking that dollar would become a little cheaper, because of which for you $100 would be less expensive to pay. So we decide that, okay, no problem, I am going to give you my badge, not today, after 6 months, let's say we do a future contract, after 6 months, I'll give you my badge at $100 and not 7,500 rupees. Now, ideally speaking, this contract has two components. One component is actually sale of lectures and the second component is speculating in the changes of dollar. And in this sense, standard says that this exactly is an embedded derivative because it is having a non-financial instrument contract which is sale of lectures, and it also has a derivative element inbuilt because the transaction or the consideration has been fixed in a currency which is not functional currency for either of the parties. None of the parties deal in this currency. So it's unnatural to deal or make a transaction in this. Had you been sitting in US or I been sitting in US and then transacting this in dollars, possibly could have been a regular routine normal transaction, not in this case. Having said that, now how do I do an accounting for it? So in that, my books, if I have to do accounting, I'll give you one simple tip which will clear all your confusions. Friends, dosto and mitros. Whenever there is a question of derivative, only thing which you need to first assess is whether there is a profit or loss. When do you make profit? There are two ways of understanding this. Number one, if I've made a purchase, then if the value goes up, I'll make money. If the value goes down, I'll lose money. But if I've made a forward sell, it will be opposite of this. Number two, What was my intention? What was I thinking? Where will the price go? If the price goes in that direction, you make money, else you lose money. I sold lectures to you at a consideration of $100 after 6 months. Means I was expecting dollar to go up, means I will make profit if the dollar becomes dearer, and mean it becomes more expensive. Finish. Now let's understand. Entity A and B both have functional currency as INR, but still they did a contract to transact in their goods in dollars, and the dollar are 10 lakh or 1 million, and it's a sale contract. So entity A would be getting dollars. If I'm getting dollars and I am expecting, I was having the choice of in rupees, but I'm getting dollars, it means I'll be happy if dollar goes up. Finish. Now what happens? Spot rate on this day was 45. Spot rate on 31st March is given to be something. 3 months forward on 31st March is given. 6 months forward on 1st January is given. Spot rate on 30th June is given. The question is very nice and sweet because it has not given you any redundant information. Sometimes to confuse you, they may give you some redundant information as well. Now, one thing is clear here that when you did this particular contract, you knew ideally from this particular sale, what you are going to make money is 55 million. Reason? You could have taken a forward of 6 months at 55. That means, ideally speaking, if you were not really speculating, you would have taken a forward and said that, okay, give me a forward, 55 bucks is what I get if I give you $1. So 55 million was my sale. So this is something which is one part of your answer. Your sale has to be recognized from 55 million only. Second, I have actually not taken a forward. This is just a thought process. Now I have to think whether I've made a gain or a loss in this. I gave you basic rule is that if I thought that dollar will go up, I will make gains. Otherwise, I will not. And in that particular sense, did the dollar go up? Let's see. So on this particular date, 1 million, if I see the forward contract rate was 55. So normally forward the value on the date of initial recognition is 0. So you don't do any entry on the date of recognition. Anyways, I have not sold the goods on 1st January, just that we've done a contract. So it is something called as a firm commitment, something what we've done. So day 0, I do no entry. Then 31st March, what I do is I assume that I have actually a contract with somebody wherein somebody is going to give me after 6 months dollar. 6 months later, if I would have got dollars, I would have said that the fair value is 55. Now after 3 months, there are still 3 months remaining to get this particular money. And if I talk to the bank or somebody that after 3 months I'm getting some kind of dollars, so they are ready to give me 57 bucks for it. So I'm not taking any of the forward contract, just to explain. The value of this thing has increased. So I think I made a gain of 2 bucks, 2 rupees. So 2 into 1 million, which is 2 lakh rupees, is my gain on 31st March. And then finally on the spot date, what happens? Okay, not 57. I have to not see the 50. I have to see this particular rate. So I would rather say that I've actually made a loss of, so there are huge differences in terms of the rates nevertheless. I would ideally say that I've actually made a loss of 10 rupees because the dollar forward contract rate has gone down. So I would have to book a loss of 10 million. And then finally what happens is the settlement happens at 60, which means I have made a gain of 15, which is 15 millions. So based on this, what entries do I do? On day 1, I'll do no entry. 31st March, I'll have to book a loss of 10 millions because 45 is the forward rate and the value has gone down. But then settlement is happened at 60, so I'll book a gain of 15. Overall, my net gain would be of 5 lakh bucks, and my sales in that case would be recognized at 55 million only. You can see the journal entries for it. There's another similar contract which says Company A, Indian company, functional currency rupees, enters into contract to purchase machinery from an unrelated local supplier in Company B. That is also a local supplier, so that means the functional currency of Company B may also be rupees, which is, however, contract is denominated in dollars. Since machine is sourced by Company B from a US based supplier, payment is due. So they have denominated in dollar because B is basically buying it in dollars and that's why it's selling it in dollars. That's okay. In this case, whether this involves a derivative or it's a need of the business, for that, what ideally you will have to do is you'll have to see what the question says. So at the end, if you sign, you will find that question specifically says that Company is required to analyze if the contract for purchase of machine from company B contains an embedded derivative and whether it should be separately accounted for on the basis of guidance given, and also give journal entries for accounting for the same. We'll have to essentially say that if the buyer and seller both are having functional currency of rupees, denominating a transaction in dollar usually will not be a usual practice, and that is why it would satisfy the conditions of embedded derivative, and hence we will have to do split accounting, wherein we'll account for the non-financial instrument or the non-financial item which is purchased in this particular case of machine separately and the derivative separately. Now I have to basically look this question from the point of view of company A. So company A is buyer is buying it in dollars, will be happy if the dollar goes down because he'll have to shell out lesser amount. The contract actually happened on 9th of September and the future date was 31st December. The purchase price was $1 million. I would have to fix the price of the machine as to what would be the forward price on 9th September for a dollar payable at 31st December. So it says forward on 9th for 31st is 67.8. So 67.8 into $1 million is fixed price of the machine. Day 0, this is basically fair value of the contract is 0 and this is my reference price. Now I'll have to go if there is a reporting date in between. So it looks that 30th September is a reporting date. And there it says that forward rate on 31st December is 67.5. Which essentially means that it has gone down by 0.3. I'll be happy because I have purchased. So 0.3 into 1 million, which is 3 lakh rupees gain is what I have made. I'll recognize a financial derivative financial asset of 3 lakh and book a gain of 3 lakh rupees. Then finally, spot rate on 31st December is given to be 67, goes further down by 0.5. I'll further be making a gain of 0.5. So essentially, I'll be paying 67 million rupees, but my asset would be recorded at 67.8 million rupees. 80 lakh rupees gain is what I'll have to record. This is the way you'll have to do your entries. 678 is your asset value, and in total, your gain is 8 lakh rupees. Cool. Next. An Indian entity functional currency rupees purchase US denominated bonds. Fair value of this is $1,000. The bond carries stated interest at 4.7% per annum on its face value. Now this is another one question which the institute had given in their RTP of 2020, I guess. And it's a decent good question because it combines two things. One of foreign currency bond which has a fixed rate of interest and hence accounted under FVOCI method, and then there is a foreign exchange gain loss component involved. I'll give you some tip in this particular question. Let's see the question carefully. So what we've done is Indian entity functional currency is rupees but has purchased a US denominated bond and the fair value of it is $1,000. So this is not similar to similar previous question because this is not that I've taken a bond from an Indian company in dollar denomination. It's actually a bond taken basically denominated in dollars, possibly from US itself. It has 4.7% on face value interest rate. The said interest is received at year end. It has a maturity of 5 years and is redeemable at face value of 1250. So which means that you will be getting 4.7% on 1250 because that's the face value. And 1000 is actually your purchase price. The fair value of the bond at year 1 end is 1060. That is the fair value. Exchange rate on date of transaction. And at the end of year 1 is 40.45 and average exchange rate is 42. Entity determines that holding the bond as part of investment portfolio's objective is met both by holding the asset to collect contractual cash flows and selling the asset. So it is hold or sell and you can use FVOCI. Now remember, bonds usually will meet the SPPI test. However, foreign currency bond may not meet the SPPI test. But then specifically Ind AS 109 says that if the fluctuations are just due to foreign currency, otherwise if the cash flows meet the SPPI test, we will consider that the foreign currency bond meets the SPPI test and hence FVOCI R method would be possibly available. The business model is hold or sell, hence you will have to follow FVOCI. It says purchase US dollar are classified as FVTOCI category, which is fair value through other comprehensive income, which will be reclassifiable. And the effective interest rate is 10% per annum because you've bought it at 1000 and it will be redeemed at 1250. So it means definitely the interest rate is going to be a little more than the coupon rate because you are going to get it at a higher price. What would be that rate be? They have given it in the question. Wonderful. Now, how do I do accounting for this? So essentially, they should have clarified that, what I need to do in this question, I possibly need to show accounting for the first year. In the first year, usually if we have an FVOCI model, what we do is we use the interest rate, effective interest rate, and we basically use the carrying amount, in fact, ignoring the fair values to calculate the interest income. So first and foremost, your interest income in this case would be how much? So your actual interest is 1250 into 4.7%. This is basically what you are going to get. But this is not going to be your interest income. So this is cash flow on interest. But your interest income you will have to recognize on your cost at effective interest rate, which in this case is 10%. Now here everything is in dollars, hence what you would have to do. 58.75. I could have shown you from the answer, but then I need to give you a trick because that is where you could possibly do something wrong in the exam. Remember, interest income is an income for the year, and any income or expense as per Ind AS 21 is recognized at average rate. So this will be recognized at 4,200. However, you will actually get this cash flow at the end of the year, so you will basically recognize it at 45 bucks. So now what happens is, please understand, at the end of the year, do we have the fair value of this? It says 1060 is the fair value. So year end, I'm sure that I will have to record this bond at this value. Now you can understand that there would be some kind of a gain or loss involved in it. Do I book that gain or loss to PRL or do I take it to OCI? Because Ind AS 21 says foreign exchange gain loss goes to PRL, but 109 says if you are using FVOCIR as a method, your fair value gain loss will go to OCIR. So I'll have to identify two separate gain losses, foreign exchange and fair valuation. How do I do that? And this is something which you'll have to focus upon. So ideally what we could possibly do is we can simply say that you took the bond at $1,000 and in this particular $1,000, so you bought the bond at $1,000. In this, ideally your interest income should have been how much? So essentially speaking, if I was recognizing this particular transaction only in dollar terms, I would have said that, okay, $1,000 was my cost. Interest income, I should have ideally booked at $100, which is 1,000 into 10%, 1,100. Minus, in terms of dollar, I would have received how much? 58.57. Sorry, 75. So ideally $1041.25 should have been the closing carrying amount of this, whereas the fair value is 1060, which means it has gone up by 18.75. Now what you can do is you can say 18.75 is basically the increase in value into the closing exchange rate. This is something which you can possibly say is your fair value gain, which comes to 855. Why it is coming to 855? Because what they have done is we've taken 58.75, whereas they have taken 59. So because they have taken a rounding off here of 0.25, almost 10-11 rupees, the answer would be different. Now once you get this, apart from that, you can simply prepare a ledger account. The balancing figure you can say as the foreign exchange gain or loss. So the trick in this question is first identify the fair value gain loss. How do you do that? Calculate through dollars as to what should be the closing amount and what is the fair value difference into the closing rate. That is something which is your fair value gain. Remaining gain loss is your foreign exchange gain loss. Fair value gain goes to OCIR and foreign exchange gain loss goes to PRL. This is the kind of entry which you will have to do. One important question. Next, cash flow hedge related question. This was there in MTP 2 of July 21 exams. The question itself has two major errors because of which ideally such kind of questions should not be asked in the exam. It should not even have come in the mock test paper. We've raised a query on this with no replies. Nevertheless, we don't have time to further raise the queries. In case if you have that kind of a thing, you can put it up. But as of now, we will just kind of try to do this question based on what the institute has done. In this case, you may ask a question, is hedge accounting something which is critical? Institute has removed all the examples of hedge accounting from the module, but then since this question has been asked, you never know, they might as well ask this particular question from you. What has happened in this question? Let's see. It says, besides construction activity, building company is also engaged in trading of copper on 1st April. It had 100 kg of copper costing 70 per kg, 7,000 bucks, which is the cost. The company has scheduled delivery of these 100 kgs of copper to its customer on 30th September 2001, which is 6 months later, at a rate of $100 on that date. So maybe my buyer is somewhere outside, so that's why I have denominated in $100. To protect itself from decline in currency exchange rate, the entity hedges its position by entering into future contract for equivalent currency unit at 76 rupees per dollar. So simple cases, I am going to make an export after 6 months. So it's capital, it's kind of a unrecognized firm commitment or a firm commitment or a highly probable transaction. And in this case, I am selling it at $100 and here I have taken a forward. Now, when you take a foreign currency forward, obviously it is a derivative. It will be accounted under FVTPL, except if that derivative meets the hedging condition, in which case, depending on whether it is a fair value hedge or a cash flow hedge, your accounting would of the derivative gain loss would accordingly change. The future contract mature on 30th September. So you've actually taken a future, unlike the previous questions. It's just that the rates were given to calculate a gain loss. Here you've actually taken a future. The management performed an assessment of the hedge effectiveness and concluded that hedging relationship qualifies to be a cash flow hedge accounting. Now, what happens in cash flow hedge accounting? It is absolutely like any derivative FVTPL accounting. You can simply say instead of FVTPL, you have to do FVOCIR. So, cash flow hedge accounting basically applies whenever you take a kind of a hedge instrument to remove the variability in your cash flows. So, here your cash flows could have gone up or down depending on the dollar exchange rate changes. You have taken a future contract, which ideally should be forward, but you've taken a future contract to mitigate those risk of changes in foreign currency. So you're basically removing the variations which could possibly come in your cash flows. Hence, it would qualify to be a cash flow hedge if the hedging relationship is effective, which it says is. The entity determines and documents that changes in fair value of the currency future contract will be highly effective in offsetting variability in cash flow. That means the hedging relationship is highly effective on 30th September. It closes out the currency future contract and it also sells the inventory of copper when the spot reaches 72 per US dollar. This is where my first problem comes in. Here they have given that the spot rate on 30th September is 72, whereas here they have given that the exchange rate for future price for 30th September on 30th September is 71, which is very, very unusual because if you take a future on 30th September for 30th September, I mean that is nothing but the spot rate. So ideally this should have been 72. Or this should have been 71. Now what they have done is they have not solved the question through 72 or 71. They have done something which is very strange. We'll come to that. Exam, if this question comes in, you'll do the same strange answer which the institute has given with possibly a note. What is to be added, I'll tell you. It says you are required to prepare detailed working and pass necessary journal entries for the sale of copper and corresponding hedge instrument taken by the company. You'll have to pass journal entries as on initial date, first quarter, which is 30th June, and date of sale, which is 30th September. Assume exchange rate as follows and yield at 6% per annum. And this is where my second problem comes in. Question says that on 1st April, future price of 30th September is 76, which means that if you take a future or a forward contract for 30th September for $1, it will tell you that, okay, you give me $1, we'll pay you 76 rupees after 6 months. Now, how does this 6% features in? Because whenever a forward price is denominated or calculated, obviously the interest factor is also taken into account. Accordingly, the forward or the future prices are set. So when I say I'm getting a forward of 6 months at 76 for $1, it means they have factored in the interest element in it. Never even in your SFM you will find any question where you have a future or a forward contract where they have given you the price for a future or forward and they are giving you an interest rate which is being adjusted. Either they will give you an interest rate and certain factors and they'll ask you to calculate the premium of the option or the forward price. But here it is not. They have given the option or the forward contract price itself. So what they have done is the institute has very strangely used this 6% for discounting the future rates which are given, which is absolutely conceptually incorrect. But nevertheless, we will still follow what they have done, following the tradition of mugging up what the institute does, even if it does it incorrectly, because this is something which comes in the exam. The answer matches with their material. I hope so, but we'll put a note on it. Now, what do I do? How do I do an accounting for this? So because this is a cash flow hedge, what you do is, number one, the derivative will be accounted as a derivative except that the gain loss will go to OCI. Number two, the transaction of sale will be recognized only when the sale actually happens as per Ind AS 115. Number three, the gain loss on the derivative will actually go to the value of sales instead of going to PRL on the date of reclassification. So first I have to do entry on 1st April only of the derivative contract, which will be no entry because initial date we will recognize derivative at fair value, and in case of futures and forward the fair value on initial recognition date is 0, hence no entry on 1st of April. Then quarter end 30th June. 30th June, what is the rate? I did a forward at 76. Now the forward is 74. I am going to purchase or sell, so I'm going to sell my copper. It means that I would have been happier if the rate would have gone up or down. So any which ways, in this particular case, I don't have to think like that. I simply have to say that I have taken a forward. I have actually taken a forward where I'll be getting 76. Now the market rates have become 74. So I'll rather be very happy. Thank God I took a forward. Otherwise, if I would have taken it today, I would have got it 74. So I'm happy, which means I've made a gain. The other way of looking at it is, and this is something quite opposite to the previous contract where there was just a probability and we didn't take a forward contract. But here we've actually taken. So we are happy because we have taken a forward where bank would pay us 76, whereas the market rate is just 74. So there's a gain. Now what is the gain? So gain looks to be 2. Now what they have done is they've said that the gain is actually not 2 because there's a 6% per annum thing involved and the contract is after 3 months. So we'll have to discount it by gain of 2 by 6% per annum, which means for 3 months it will be 1.5%. So 2 divided by 1.1015 is basically what the gain is, 1.81. So what they have done is accordingly, they have calculated their gain like this. So they have taken a discounting factor here, which is 1 divided by 1.015, which comes to 985. And 985 into what is the difference? So into 2 is what we calculated into $100 contract. So 197 is your gain. So what they have done is on 30th of June, they have recognized a gain of 197, which is being transferred to OCI. Then on the spot date, what happens is 71 is the closure rate. So now there is no obviously interest element involved. So you will further book a gain. So a total gain of 5 into 100. So 500 is your total gain. That means you'll have to additionally recognize a gain of 303. 303 additionally recognized in OCI. Now they've executed this particular sale, which essentially means that when you book this particular sale, what they are saying is you will receive 7,200 because the spot rate here is 72. Ideally, this should have been 71. So 7,200 plus 500 gain you will transfer to revenue. So because you have taken a hedge, OCI would be reclassified to the purpose for which you have taken the hedge, because on day one itself you had fixed your price. Hence 72 plus 500, 7,700 ideally would be your sale price. Actually speaking, your selling price should have been 7,600, which was decided at the very first day when you took a forward at 76. That day itself you knew that 76 is what you are going to get against these $100. But why is 7,700 in this case? Because there is a difference between this 72 and 71. Had this been 72, your gain would have been 400 plus 7,200, 7,600. Had this been 71, then here you would have got 7,100 plus 500 gain, total 7,600. So ideally 7,600 would have been your selling price, which is not the case in this example because of the error in the question. And future contract bank will pay you $500 because when the settlement happens, essentially even if you do a net settlement, Bank is going to tell you that, okay, you took forward at 76, so I'll give you 76, against which you'll have to give me $1, and I would give dollar as in 71 basically by buying it from the market. So this is the way they've kind of solved this. Strange. This is another question which is a very different question, because none of these questions or similar question was there in the study material. Nevertheless, a pretty simple and direct question. Accounting for financial guarantee. Remember, financial guarantees are accounted for under Ind AS 109. Performance guarantees are accounted under Ind AS 37. How are financial guarantees accounted for? It says that you will account for financial guarantee as a financial liability at higher of fair value or the unamortized revenue in that guarantee. Usually what happens is, if I go to a bank and I say that, okay, I want to, let's say for example, I am getting a loan from World Bank, but they want guarantee from my local bank, and you are my local bank, I have so many transactions with you, I have so many of my securities kept mortgaged with you. Please, why don't you give me a guarantee? So World Bank would fetch or need some kind of a guarantee. So when I go to a bank and then get a guarantee from them, obviously bank would charge me a fees for that guarantee. Now obviously bank will not follow Ind AS. So in this particular question, situation created is that subsidiary is taking a loan from somewhere and parent is giving a bank guarantee on behalf of subsidiary to the lender. Because the parent is giving a bank guarantee, ideally parent should have charged some fees on that bank guarantee, which it is not charged, being it is a subsidiary. Ind AS would say that financial guarantee still, we will assume that had fees been charged, what would have been the value of that particular fees. And ideally we should have got that money, so we should have done bank account debit to financial guarantee as a liability, and that financial guarantee fees which we have charged, if it is for more than 1 year, then we would defer it and we'll recognize income on it. But since we have not got any money, we will simply debit investment in subsidiary, with the same logic that if I give a concessional interest rate loan to my subsidiary, the loss which I am making of interest, the notional loss, opportunity loss, is something which I treat as investment. With that same logic, how the question has been created in this situation, let's see. Sun Limited guarantees 10 lakh loan of subsidiary Moon Limited, which bank has given to Moon Limited for 3 years at 8%. So the guarantee also would be for 3 years. Interest payments are made at the end of each year. Principal is repaid at the end of the loan term. Sum has not issued. If Sun had not issued the guarantee, then interest rate would have been 11%. So it essentially means that the fair value of the financial guarantee can be calculated as in the notional interest savings which the subsidiary is making, in this case of 3%, which means 30,000 per annum. So fair value of your financial guarantee on initial recognition would be 30,000 into annuity factor at whatever is the market rate of interest, which looks to be 11% for 3 years. Ideally, Sun should have charged this money, but they have not charged anything for providing the guarantee. So this is the fair value of the guarantee at initial recognition date. In fact, this is actually not the fair value. It is actually the revenue which you should have received. Ideally 30, 30, 30 at the end of first, second, third year. Present value, if I calculate, it will be present value of 30,000 for 3 years. So what they've done is they've calculated this 30, 30, 30 present values, annuity factor they've calculated to 73320. So this is initial recognition entry, investment in subsidiary to financial guarantee. Now Ind AS 109 says that this is your income which you should recognize over a period of 3 years. And the unamortized revenue which you have, that or the fair value of the financial guarantee, whichever is higher, would be the value at which the financial liability for financial guarantee would be recognized. Now, what is the fair value of financial guarantee? It is basically the possible loss which you might have to bear when you give guarantee on behalf of someone else. So there will be some information about it in the question. 31st March 2002, which is after 1 year. 1% probability that Moon Limited may default on the loan in the next 12 months. So probability for default is 1%. If it defaults, does not expect to recover anything. So loss given default is 100%. Now impairment loss is exposure amount into probability for default into loss given default, which means ideally this is going to be 10,000. So year 1 end, 10,000 is the fair value of financial guarantee. And what is the unamortized revenue? It will simply be 30,000 into annuity factor at 11% the market rate of interest initially for another 2 years, because that's the amount which is next 2 years I would have taken 30. So present value if I calculate, so if I 1 divided by 1 point equal to GT into 30,000 comes to 51375. So they have calculated something like 51385. What is higher, 51385 or 10,000? No marks for guessing. 51385. What is 51385? Year 1 and financial guarantee value. Year 1 beginning financial guarantee was 73320. So that means your liability has gone down. So this difference would be 21935 or something, whatever it comes, would be your income. So in this year, you will book an income of 21935 and reduce your guarantee by that amount. Now what happens at the end of second year? Similar calculations follow. At the end of second year, you will calculate this value. So it says 31st March 3% probability, and if default happens, nothing is expected to be recovered. So financial guarantee fair value would be 30,000. Present value of your unamortized revenue is 30,000 for the next year into present value at 11% for 1 year. Whichever is lesser, so obviously, whichever is higher, so obviously 30,000 is going to be higher. So 51385 to 30,000, 21385 is your income which you'll have to recognize in the next year. That's about it. You have been asked the question only for 2 years. Next is another example of regular way purchase sale. Some kind of question like this would come. I'll give you a simple tip here. Whenever you do a transaction through any exchange, it may happen that you trade today, but settlement happens at a later date. That is where regular way purchase sale concept kicks in. In this, you have an option either to record your asset on the trade date itself or on the settlement date. It's a choice of accounting policy. Either ways, your gain or loss should not differ. Hence, let's say, for example, you've done a transaction on 28th March, which is settled on 2nd April. Trade date accounting, 20th March itself, you will recognize the financial asset investment. Settlement date accounting, you will recognize the asset on 2nd of April. But in both the cases, your gain loss as on 31st March has to be recognized because your price is fixed on 28th of March, which is the transaction date. So based on that, there is this particular question. On 1st January, you have entered into contract of 10 lakh. Fair value on that date was same. 4th January, settlement date, the fair value is 10.5. How will you record? And then they have done these kind of entries. So you can kind of go through this particular question, but remember gain loss in either case should remain the same. Another question very popularly asked in the old course, one's asked in the new course as well, partial derecognition. In a question of partial derecognition, first and foremost understand what is this concept. This concept says that if you, let's say, for example, have a bond, loan, any kind of a financial asset, either you could sell it completely or you can sell it partially. When you sell specifically identified cash flows or a percentage of specifically identified cash flows, then in that particular case, partial derecognition would apply. In that case, the part which you have sold, you will book a gain loss on that, and the remaining part would be carried at carrying amount. So profit or loss is calculated only on the part sold. Now, for example, I have given a loan to someone at 10% interest rate for 3 years. Someone comes to me and says that, I want let's only the interest cash flows from the loan and principal you keep. So I'll say, okay, no problem. I'm selling you the interest cash flow. So whatever interest cash flow I receive as it is, I'll transfer it to you. Whenever I receive, I'll give it to you. If I receive, I'll give it to you. If I don't receive, I'll not give it to you. That means I've actually done a transfer of risk or reward, but of interest only. Principal still is retained with me. Whatever money I've got, should I recognize that as cash bank debit to asset? No, because there could be a gain or loss element in it. How do I calculate that? So I need to first calculate the cost of the component which I have sold or the carrying amount of it. How do I calculate that? So here partial derecognition applies because I have sold a specifically identified stream of cash flows completely. The standard says that what you do is you calculate the fair value of the amount which you've sold and the fair value of the portion which you have kept, and you split your carrying amount in that ratio. The carrying amount of the principal portion which you have retained will be continued in your books, and the carrying amount of the interest portion which you have sold will be derecognized, and what you have received, difference will go to PRL. Normally, as a treatment, what we do is, say for example, 100 rupees was the loan amount in my books, out of which the interest cash flow which I have transferred, let's say the fair value of those interest cash flows come to 25 and I have sold it at 30. What I would do is, I would derecognize 25, receive 30, book a profit of 5 rupees. But in my journal entry, I will debit my whole asset of 100 rupees, loan 100, to interest strip sold 25, to principal strip retained 75. And interest strip sold 25 would then be actually transferred at 30 rupees and I'll book a gain of 5 rupees there. So in this case, what has happened is I have lent somebody 10 lakh at 18% for 10 years. Fair value was 1223960 because I have given loan at 18%, but the market rate today is 13%. So definitely I'm very happy because I've given loan at a higher rate and this is a financial asset for me. I have risk that the other person may prepay it earlier. In order to kind of mitigate my risk, I think I should sell this loan to somebody. So I've sold right to receive principal and interest, wherein what I've done is I've just retained 10% of principal and 4% of interest. Partial derecognition applies because 1, you have sold specific cash flows which is interest and principal, and 2, if not completely, in percentage, proportionate amount. And the portion which I have retained, the fair value of that is given. So if you know the fair value of the retained portion, you know the fair value of the total portion. Obviously, the fair value of the portion sold will be the difference of this. So 1223960 minus 29 and 184620 is the fair value of the portion which has been sold. Now in the proportion of 1010340, 29,000 and 184620, ideally you should split your carrying amount, which in this case is 10 lakh. The carrying amount which relates to the portion sold will then be compared with the selling price to calculate the profit or loss. Question says consideration is 9,90,000. This 990 is for the part which you have sold, which has a fair value of 10,340. It says interest component also has some service fee of 65160. So it says that 184620 has 2 components, 65160, and this is the balancing figure, which is the interest rate. You will just kind of split it between 2 and you will have to recognize a set accordingly between these 2. So what you first do is you split your whole fair value of 1223960 in proportion of respective fair value of each component and calculate the carrying amount. These 3 carrying amount to continue in books because this is what you have retained. However, this is what you have transferred at 990. This minus 990 is your gain. So 990 minus this is your gain, because you've sold it at 990 and the carrying amount is 825. So this is your gain which you have recognized, and the other things you have recognized. So you derecognize the whole loan and recognize a new fresh loan. It is not like that. You've actually just derecognized the part which you've sold and booked the gain only on that part. Remaining part you've just kind of changed the nomenclature. It was first in the name of loan, now it is specifically cash flows. That's about it. And then there's the special question which the institute added in the study material. Not likely to be asked in exam, but many students do get confused with this question. That's why I've included in the question bank. Financial liability with a prepayment option. First and foremost, let me get you the concept of this as to what it is. When you have a financial liability with a prepayment option, it essentially means that you've taken a fixed interest rate loan from a bank. However, you risk that since you've taken a fixed interest rate loan from the bank, if the market rate of interest in future go really low, this loan may relatively be expensive, dearer for you. So either you will go for a variable interest rate loan where there is a risk. If the risk increases, you'll have to pay a higher rate, or you'll go with fixed if you don't want that risk. But then if the rate really go down, then what happens? So you'll ask the bank and say that if I want to prepay this loan early, do I have a choice? RBI says usually individuals can prepay any loan without any kind of a penalty, but that is not applicable for corporates, and this applies to corporates. So real life scenario, it could so happen that if I take a loan from a bank at fixed rate of interest, let's say for 5, 10, 15 years, the bank would say you will have to pay this amount of interest. And you cannot prepay the loan, only pay it. You will have to pay it like this only. I'll be surprised because I have money I want to pay. So bank would say if you will have to pay this early, then you at the time of inception of the loan itself, you will have to, in the contract, we will have to give you an option that you can prepay. But in that case, we may charge a little higher rate of interest from you. We may also charge a prepayment penalty. This is what the question is about. So I have borrowed 100 crores, 1st April 2001, 12% interest, and it has to be repaid at the end of the term with a bullet repayment, one-shot repayment of principal. Interest obviously is payable every year. If the question is silent, that's what we assume. 6 years is the term. I have an option to prepay the loan at 1st April each year. That means basically after the end of every year, I have one-time option in that year to prepay it, but I will have to prepay it with a penalty of 3% on 100 crores, which is 3 crores. There are no transaction costs. Plus, without prepayment, the interest rate quoted would have been 11%. So, bank says that either you take it at 11% and then you complete 6-year tenure and then only repay, you cannot pay it early. Or you pay whenever you want, but then interest rate would be 12%. And if you pay before 6 years, then you'll have to extra pay 3% as a prepayment penalty. This is what the contract is. Now, the question which comes is, I have taken a loan wherein I am giving a higher interest rate and I will also pay a 3% penalty just to get one option to pay the loan early if I want. That means to get this prepayment option, this is the premium which I have paid. It is a financial liability. I have paid an additional sum in this loan, and that is to get an option to repay this loan early. Is this not a financial liability plus a derivative where the premium I have paid to become or entitled to be a holder of an option to prepay it early? And then it should be an embedded derivative. Split accounting should apply. Financial liability carried as per ACM and the derivative component carried separately. If you would have seen the embedded derivative concepts, I actually don't want to refer the concepts and the notes for the moment, but just to kind of relate you well with it. Embedded derivative concept requires you to apply split accounting, which specifically says that concept or embedded derivative accounting is only done where the contract is of a financial liability or a non-financial instrument. In this case, it's a financial liability. Plus, the host contract is not measured at FVTPL, so financial liability will be measured at ACM. Plus, the derivative is substantially and significantly changing the cash flows of the contract, and it is not like naturally embedded as a part and parcel of that package. And the fair value of the both the portions can be separately identified. So these are those set of conditions which you can kind of, if you want to read through, quickly go through. Because this question has a lot of problem in terms of the students' understanding, this is why I'm kind of harping on this. It says derivative leads to significant changes in cash flow from the host contract. In this example, it is the loan contract. Now, when do I say that the derivative has changed my cash flow significantly? So for that, I will have to have an accounting policy or an estimation involved, not a policy. So what the standard says is, first let's see whether we have to do an accounting for split accounting or not, as in segregate the derivative and the loan component or not. Then we'll decide further. So for that, what they have done is they've said that let's see what are your actual cash outflows. So my actual cash outflows are going to be 12, 12, 12, 12, 12 for 6 years and 100 at the end of last year. If I would have paid this money and I would have said that, oh, I don't want a prepayment option, but I am ready to pay 12, 12, 12, the bank would have given me a higher amount at the initial date itself, because the rate of interest then would be 11%. Discounting this with 11%, I would have got 104.22. I've got actually 100. 4.22 is additionally what I have paid just for that premium. So that is the fair value of the option contract or the option which I've got in the initial date. If split accounting applies on day 0, I would do an accounting wherein I would say loan taken So I'll debit bank by 100, but I'll credit my financial liability by 104.22, which is the fair value at 11%, and I'll debit derivative financial asset by 4.22, which is basically the option premium which I've calculated using this fair value logics. Fundamentally, what we are doing is we're just saying that I am paying what? 12, 12, 12 for 6 years. If I would have paid this to any person, I would have said, don't give me a prepayment option, then he would have given me 11% loan. So with the same cash flows, I would have got a higher money. I've got lesser because of that option of prepayment. Hence, the difference here is the fair value of the option or the premium which I paid for the option. That's the logic. If I have to do split accounting, now whether I have to do or not, that depends on the one of the condition that derivative essentially changes the cash flows of the contract significantly. Now let's check that whether it's happening or not. So if I would have got a loan of 104.22, how would I have accounted that? So I would have recognized at 104.22, then 11% interest, and then I would have paid 12 bucks. So what would have been my amortized cost? So 104.22 into 1.11 minus 12. So my amortized cost would have been 103.68 at the end of first year. Second year, what would have happened? Again into 1.11, but I would have paid 12 bucks, then 103.09. So 103.09. So these are the amortized cost. Now what it says is, without the option contract, your amortized cost would have been this. So this would have been the value of your loan. However, the fair value of the loan at the end of every year end is 103, because you'll have to, if you want to pay it early, you'll have to pay a prepayment penalty of 3. So ideally speaking, without prepayment option and with prepayment option at the end of every year, there is no significant difference in the values. And if I calculate these particular differences in percentage term, these are the differences. Now they've just given an explanation that if the company feels that difference up to 3% are acceptable, they are not substantial, we will conclude that this particular prepayment option has not really created any kind of a problem for us, because of the simple reason that because of this prepayment option, technically speaking, my fair value of the loan or the carrying amount of the loan is not significantly different from its settlement price. And hence I will not do derivative accounting. So simply I will recognize a loan of 100 and 12 will be my effective interest rate which I'll book. And if I do a prepayment, I'll additionally recognize a loss of 3. That is a derecognition loss. But if I say no, 1% or more variation itself is treated as significant, or 2% or more is treated as significant, then 1 year it is going beyond 2%, so it will be an embedded derivative. So I'll have to do a split accounting. Split accounting, day 0 journal entry, I told you that is what you will have to do. That is not given in the study material. So this is basically more of a discussion which we had to do rather than doing the question completely. In the regular class, we solve this question. Even if it was an embedded derivative, how we would solve this question completely, and we also take some more practice question. Nevertheless, here that's about. Next, another question which possibly may come in the exam, because it merits to be asked in the exam sometime, maybe for a 4 or 5 marks. Simple question which is basically of factoring with partial recourse. I had 100 rupees data which I had given to a factor, and the factor gave me 90 rupees, and this is without recourse, which means I've got 90 rupees. Now whether the debtor pays money or not, I'm least bothered because this is without recourse. So if there is a bad debt, it's a loss of the factor. This is complete derecognition. But then the factor may say that, see, if bad debts happen up to an amount of 20 rupees, you'll have to bear. Beyond that, don't bear it. So that means here, I have lost control, but I still have some involvement in the asset. Derecognition principle says that when you have transferred the risk and rewards, but you've also retained it to some extent, and the control is lost, in such case, there's a very special accounting what you do. You first derecognize your asset because you've lost control over it. But whatever is your continuing involvement in that particular asset, you recognize that asset as well as a liability towards it. And if you feel that there could be a possible loss on it, you will also have to recognize the loss, because you have basically given a financial guarantee to the factor that loss to the extent of 20 I would recoup or bear. With this logic in this particular question, what has happened essentially is entity C agrees with the factoring company, under which the factor pays 91.5 crore less service charge of 1.5 as in 90 crores against a short-term receivable of 100 crores. And the carrying amount is 95 crores. So which means against 95 crores, I've got 90 crores. Finish. So 5 crore loss is for sure happening with me. Customer will be paid directly to a amount which goes to the factor. But we also write a guarantee that any credit loss, as in bad debts, up to 5 crores, over and above the expected credit loss of 5 crore, because see, 100 crore is the carrying amount of the debtors or the trade receivables. 95 is the carrying amount which I have in my books. That means 5 crore loss I was otherwise expecting. I'm saying over and above that, if there is another 5 crore loss, then I would bear it. And losses up to total of 15 crores are expected. The guarantee which you have given for this 5 crore has a fair value of 0.5. So first and foremost, what entry do? You know that 95, if every debtor pays, even then you will not receive more than 90 crores. See what happens when you sell a debtor to a factor at 90 crores. If every debtor pays, you don't get any extra money, right? So you've got 90 against 95. So 5 is definitely you've lost. So that 5 is your loss. Plus apart from that, you have given a guarantee which has a fair value of 0.5. So that 0.5 is your additional loss because financial guarantees are to be recognized. So what you do is in this particular case, you will recognize a total loss on 5.5 crore. The way you will have to answer your questions in the exam here is first fix what is the total loss. Then derecognize the whole asset at carrying amount 95 and debit bank with what you have received. This is simplest because you know actually what you have received. What you have to do is whatever additional guarantee you have given, so your involvement in the asset to now is 5 crore because you say that up to 5 crores I'll reimburse the loss. Now see, you don't have to pay 5 crores. If no bad debts happen, you don't have to pay anything. You don't get anything extra. So you don't have any asset, you don't have liability if everybody pays. But if everybody does not pay, then in that case, you will have to pay him 5 crore rupees. Obviously, you also have the right to receive that money from the debtor if he is not paying. So what it says is you will have to do a contra entry wherein you debit asset by 5 crore and you create a liability by 5 crore. It's a contra entry, so ideally it will get knocked off. So however, the standard does not say that in the balance sheet it has to be knocked off. So you'll have to possibly show it separately or knock it off with a disclosure because the offsetting principles of Ind AS 1 applies. But there's no specific guidance here in 32 or 109. So 5 and 5. But then financial guarantee is to be additionally recognized. So you will credit financial guarantee by 0.5 crores. The standard says that it will be added or clubbed in associated liability itself. That's why the associated liability is at 5.5 crores. Next. Entity purchases a debt instrument with fair value of 1015 March and measures the debt instrument at fair value through other comprehensive income. So it says that I have purchased a debt instrument for $1,000 and it is FVOCI. Interest rate is 5% for 10 years and effective rate is also the same. It is not originally credit impaired asset, so I don't have to do a lifetime impairment loss check. On 31st March, fair value has decreased to 950. So I'll book a loss of 50 from OCI because this is OCI. Debts OCI are. It says there's no significant increase in credit risk. Hence, you will do a 12 months expected credit loss. And it says 12 months expected credit loss gives you an impairment loss of 30. So to the extent of 30, impairment loss will be debited to PRL. So ideally, your total loss is 50, 20 to OCI and 30 to PRL. This is your journal entry, what you will have to pass. That's about it. Then it says we have also sold it at 950. So 950 when you sell carrying amount was 950. 20 OCI will be reclassified to PRL because it is OCI. Next is processing fees. If you have taken a loan, you've paid a processing fees upfront, but a part of the loan has been only taken. The part of the processing fees that relates to the undispersed or the unavailed part will still be deferred as an asset till the loan of the remaining part is taken and will be adjusted from the remaining part. But if you decide not to withdraw the remaining part, then you'll have to charge that amount to PRL. That is what a theory small question. Wow, this completes financial instrument, one of the chapter with the trickier and the possibly difficult questions as well as the probable questions that could be asked in the exam. Share-based payment, again we expect a question on this. Institute has asked questions on modification, stock appreciation right, equity settled, alternative cash settled arrangements. So I am really not very confident as to what they can possibly ask. So what I've done is the common questions which they have asked repetitively in the exams, I have not included those. I have only included here those kind of questions which you may find a problem or the newer type of questions. So there are hardly 3 questions which I have kind of included here. Do not expect to get a question only one of these 3 questions, but then the simpler ones are just kind of excluded here specifically in this chapter. This is relating to group companies. Remember, whenever there is a question which involves that parent gives ESOP of parent company to employees of its subsidiary, remember two things. One, employee cost would be recognized in the books of the company where the employee is giving the service. Two, if that company is not giving the ESOP, somebody else is giving, then definitely that company would be paying some money to the other company. If it is not, then we will consider that the parent is putting money into the subsidiary out of its own pocket, or benefiting or helping the subsidiary out of its own pocket. So parent will recognize an investment, subsidiary will credit it to equity. This is one good question where parent gives 30 shares to 100 employees of subsidiary. Condition that employee will have to be there for 3 years. And we expect all employees to continue, and none of them have left. Fair value of the share on the grant is 5 per share. It should be fair value of the option. Company has agrees to reimburse 75% of the expense, or 25% will go to investment equity. Now, what is the expense? 30 share to 100 employees will be 3,000 shares in total, fair value 5, so 15,000 bucks. Every year expense would be 5,000 bucks. 5,000 rupees would be your per annum expense, out of which 75% would be repaid. So subsidiary will recognize an employee benefit expense of how much? 5,000. Out of which it has to pay to parent 75%. Balance is a credit to equity. Parent, what it will do, it will not recognize an employee benefit expense because employee is not giving service to the parent. But parent has basically entered into contract which will give it a cost of 5,000 per annum. So what they would do is they would credit share-based payment reserve by 5,000. But they will not debit employee benefit expense. Rather, out of this, they are getting 3,750 and 1,250 they are not getting. They ideally should have got. So this is an investment in subsidiary. That's about it. This is one good question which you may get a 4 or 5 marks kind of a question, but not possibly you may get it as a question, but this one of these particular adjustments can become a part of the question which you can get in the exam, which is relating to grant date. In ESOPs, it is very important and imperative for you to understand that it is the grant date which is considered for determining the fair value of the transaction. So let's say, for example, I'm giving a ESOP scheme to my employees. It is the grant date fair value which will be recognized in expense. If I'm taking an asset and against that asset I'm agreeing to give shares, it is the grant date fair value of the shares which will be recognized or considered as the base. If I have to take the value of the share as the base for value of asset. Usually what happens is when you buy any particular asset and decide that consideration will be paid in terms of shares, you basically take the fair value of the asset. So fair value of what date? The grant date. So in this case, it says 1st April, New Age Technology Limited decided to grant shares to option to its employee. The scheme was approved by employees on 30th June. New Age Technology determined fair value of share option to be the value of equity share on 1st April. So they have taken the fair value on 1st April. If this is the grant date, that's okay. If the grant date is 30th June, then this is not okay. So now what is the grant date? The grant date is defined in 102 as the date when the company issues the scheme to the employees. However, if there is any kind of an approval which is required, then once the approval is received, only then it will be treated that the options have been granted. In this case, employee approval was required, hence 30th June is when we have received the approval, so the grant date is going to be 30th of June. Next, 1st April 2001, New Age Technology entered into contract to purchase an IT equipment from Bombay Software and agreed it will be settled by issuing equity shares. So here the contract has been entered on 1st of April. The grant date is 1st of April. New Age Technology received the equipment on 30th July. So asset would be recognized only on 30th of July. The share-based payment transaction was measured based on fair value of equity instrument on 1st of April, which is the grant date. So what it says is 1st April is the grant date, 30th June is the measurement date. The date when the entity and counterparty enter into contract, agree for settlement is the basis for grant date, and the measurement date basis is when you actually. So you don't recognize the asset unless you receive it. So only when you receive it, you will recognize it. But the grant date will be the basis for the determination of your value. New Age decided to grant share option to its employees. Scheme was approved by employees on 30th June. However, shareholder approval was required and shareholder approved it on 30th September. So this is basically the grant date. Fair value of equity instrument was taken on 30th of September, which is fine. And then we have this particular question from the recent MTP stock appreciation, right? I thought it is relevant. You could kind of possibly do this. 31st March 2004. Financial statement were approved on 12th May. Events for 31st March were stock appreciation right given on 1st April 2002, 2 years ago, 10 million shares. Receive cash equal to appreciation on the share price since the grant date. So any cash variations, you will get it as a gain. Right vested on March 2004 and payment was scheduled on 1st May 2004. Now remember, stock appreciation right, you will create provision based on the fair value at your end. However, the actual expense will only be known when the shares get exercised, because that is the date when you decide, in fact, when the employee say that I want cash, and that is the date when you see the market value of the share and the exercise price difference is paid. However, if after the balance sheet date the shares are before the approval of financial statement exercised, the rights are exercised and the cash is taken, any subsequent gain loss is recognized in the next year, but because that relates to changes in share prices in the next year. So that is not adjusted here. So it says fair value of stock appreciation right on 31st March 2003 was 6. And that is the end of first year. So if given 10 million shares into 6 into vesting period is 2 years. So 30 million should have been your expense here. And 31st March 2000, it was 8. So your expense should be 80 million in total. That means 30 you have recognized. So you will have to recognize another 50 million of expense. 1st May it was 9. So you'll have to pay 90 million. So you'll have to recognize another 10. But this will not be in the current year. This will be in 2004-5 next year. This would be in 3-4 and this would be in the first year. Company has recognized liability for SAR on 31st March 2002. This is not correct. This should be 3. ICI needs to correct it. Based upon 102, but it was stated as same amount at 31st March 2004. So that means they had stated it at, here they would have done it at 30 million. So here also they had recognized at 30. So we'll say 50 additionally you'll have to recognize. Discuss the accounting treatment of above for 31st March 2004. Implications of event occurring, you also have to take that. So you'll have to say that we will not consider the fair value changes which have happened later. So this completes your share based payment as well. Now let's move on to the next one. Okay, so the next one is Ind AS 1/Schedule 3 / preparation and presentation of financial statement, and there are a lot of lengthy comprehensive questions which the institute has given on this. They have also asked once in the exam the compulsory question for 15 marks. This time what is going to come in compulsory in December 21, nobody knows unless you have the paper with you. But then for sure there is a possibility that Ind AS 1 Schedule 3 question might as well be asked. So what I have done here, I have included primarily the newer questions which have been added, because they are more probable to be asked, because some questions have already been asked in the exams earlier. First, if we get a 5-mark kind of a question from Schedule 3, possibly this could be one of those particular questions. The question says XYZ is a blah blah blah, some company has it's a loan company, it has no subsidiary JV, 31st March 2001. You're not sure about certain things and they want your evaluation and preparation of financial statement. It says there are qualification audit report of company with reference to 2 Ind AS. We would simply say that auditor may qualify the report. The question ideally should have been more explicit. It should have ideally asked that can we mention that financial statements have been prepared as per Ind AS. So Ind AS 1 says that you can give an explicit you have to give an explicit unreserved statement that financial statement are complied with Ind AS, and you have to follow all Ind AS. In that, if auditor gives an opinion that certain Ind AS are not followed, that's still possible because they may differ with the management in terms of certain matters. But then the company cannot create an exception that we have followed all Ind AS except few. So auditor's report is fine, but we'll still have to give an explicit unreserved statement following and complying with all the statements. Is it mandatory to add standalone before each component of financial statement? So I would say it is not mandatory, but then yes, financial statement which are separate / standalone should be identified separately from consolidated. Standalone is a word which is given in Companies Act that you have to say that your financial statement, you have to prepare two financial statements, standalone and consolidated, and that is why we use the term standalone. Otherwise, Ind AS requires it to be denominated, in fact, there's terms it to be a separate financial statement. Nevertheless, so we'll say not mandatory, but then you have to identify financial statement separately as to what is consolidated and what is separate. Indian company presented financial statement in rupees. Is it necessary to write in financial statement that financial statement have been presented in rupees? Ind AS 1 specifically says that your presentation currency, functional currency and presentation currency needs to be specified. So presentation currency has to be specified, plus be given at respective places for the purpose of clarity. Next, company is having a turnover of 180 crores. Is company wanting to produce it in absolute figures without rounding off? It is not permitted, because if you have turnover running in 100 crores or more, you have to round off, and in fact you can round it off up to crores. But rounding off is something which is mandatory. Schedule 3 and Ind AS 1 both says company shall round off in hundreds, thousands, lakhs, millions or crores if the turnover is 100 crores or more. So rounding off is mandatory. Another case where company did last year transaction with 10 related parties. This year it is done with 4 related parties. Question says that this year when we show comparative, we should show it only with the 4 which you've done in the current year, all the 10. The answer is comparatives have to be given for every information presented in the current year with respect to what was there in the previous year, for facilitating comparison and and also helping users to understand in a comparative form as to what was there in previous years. So you will have to disclose all the related party transactions as in, and not just the 4. Next, following are financial statements of Abraham Limited, 31st March 2020. And this looks to be the old format, equity, liability, assets. So ideally, question would ask you to prepare financial statements as per Ind AS. Let's see what the last line is. Identify and report errors and misstatement in the above extract and prepare corrected balance sheet and statement of profit loss where required. Relevant notes and explanations are also required. So it's a rectification of error kind of a final accounts question if you compare it with your intermediate foundation or 12th class. In this, you will have to prepare it as per Ind AS. More importantly, in your answer, everything which you correct, you will have to, through a note, explain that. It does not say you have to prepare it as per Schedule 3, so you don't have to be very, very peculiar about the format, the note, the number and everything, but to the extent possible, you should try to follow that. First and foremost, on the balance sheet, you will have to first show assets, non-current, current, then equity and liabilities. Within that, equity, non-current and current liabilities. Equity again will be no shareholder funds, will be equity, share capital and other equity. Along with a statement of changes in equity. So share capital, you should read through this and identify if there are any possible hidden adjustments. So share capital, shares 10 each. Now because the question also says you have to prepare a P&L and you have share capital as well as fair value of share given, and we have to prepare a P&L, remember to disclose EPS also. That is one mistake which a student may do, may not present EPS because as a normal practice that's not something which is done. Remember to disclose EPS. Non-current liability, you have long-term borrowing, deferred tax liability. Ideally, you should classify between financial liabilities and others as well. Trade payable will go to financial liability, short-term provision separately, other current liability. Let's see what it is. If nothing is specified, we will assume that it is other than financial liabilities. Property, plant, equipment, deferred tax asset, non-current asset, that's fine. But then you have deferred tax liability and assets. If they govern to the same laws, you should net it off and present. You'll have to give note of these things and then you'll have to present it. Inventory is okay. Trade receivable will be a part of financial asset. Cash and bank balance part of financial asset. Statement of profit and loss nomenclature is okay. You period should be given here for the year ended. It's given here. That's okay. Revenue from operation, different cost, expense, PBT, tax, profit after tax. That's fine. If you have current and deferred tax, you can show it separately. Notes, reserves and surplus. Capital reserve is fine. Surplus from P&L known as retained earnings. Opening balance addition, that's okay. Reserve for foreseeable loss should be shown as a provision and not a reserve. So it will be removed from here and shown under provision. If the question specifies it is short term, then short term provisions would be increased or else long term. Term loan from bank, if question is silent, assume it to be non-current financial liability. They netted off if it's from the same law. Other current liability, unclaimed dividend is a financial liability. Advance billing is not a financial liability and hence it will be treated as part of other current liability because here you don't have to repay money but give goods or services. And other current liability, again because this is not given under financial liability, assume not financial liability. Trade receivable considered good, doubtful, provision for bad debt. This is not the way we present nowadays. We say consider good and considered good secured, good unsecured, credit significant increase in credit risk and credit impaired. So here doubtful, we'll have to rename it as trade receivables with significant increase in credit risk. Okay, we'll show it under financial list. You'll have to give a disclosure of number of shares. 700 will be financial liability under current liabilities. Balance 5,000 would be financial liability under non-current liabilities. Service contract due, so it will be a short-term provision. Inventory recognized at 1200, to be recognized at 1200, 300 loss to be recognized. Where do you book this loss? P&L, do we have a line item for it? If not, you can add it separately or add it as a part of operating cost. Simply in the answer, usually institute will put it as changes in inventory, 300 loss. Dividend was proposed after the year end, so you will have to just add a disclosure and give a note that we will not account it. 300 not booked, so you will have to do two things. P&L other income will have to be increased and then you will normally increase financial assets. Accrued interest treated as current asset. Deferred tax laid to same, so netted off. Identify and report the errors. You'll have to report it like this as in adjustments. And then you'll have to prepare the balance sheet and P&L. Let's see this EPS is given here specifically. Remember that. Statement of changes in equity is to be prepared like opening, changes, closing, and then other equity in the same fashion, and then all the notes. That's about it. Offsetting permitted if holding is doing expense on behalf of subsidiary, which is in nature of reimbursement. Whether we can do offsetting, Ind AS 4 says offsetting is permitted in 4 cases or 4 rules there. 1, if any Ind AS specifically permits it, you can do that. Second, similar nature transactions can be offsetted as in profit and loss from sale of PPEs can be offsetted unless if it is material. Third, substance represent offsetting would represent the substance, then you should. So if holding is specifically doing these reimbursements and incurring these expenses on behalf of subsidiary only, then definitely offsetting would represent the substance of the transaction. So you should offset, you should give a conditional answer like this in this case. And provisions on asset should always be netted off from asset, that is not treated as offsetting. So first is done. Profit on sale can be offsetted, yes, unless if it is material, then shown separately. Service rendered in transaction with an entity and service received from entity in 2 different arrangements can receivable and payable be offset. Because this is a financial asset, Ind AS 32 applies. It says that A, if you have a legal right, plus B, if you intend to offset it, then you should show assets and liabilities as net, otherwise show it as gross. This is another new question recently asked in one of these MTPs or RTPs. Master Creator Private Limited subsidiary of a listed company as follows Ind AS. I have given you the draft balance sheet. So we have the balance sheet for 31st March 2002. Let's see what the question says. A lot of additional information. You are accounts manager. Oh, CFO, we should have been at least like, nevertheless. Identify errors and misstatement in the balance sheet and prepare collected balance sheet with details on the face of balance sheet. There is no need to prepare notes to accounts after considering additional information and give explanation. So again, explanation you'll have to make, don't need to make notes. If you wish, you may, but otherwise you'll just give it as working notes. You'll give everything in the phase. Schedule 3 format exactly may not be followed, as in you can give things on the balance sheet phase and not notes. Give disclosures and explanations for everything. No P&L is required, remember. Let's see what the question is. So non-current asset, PP is fine. Financial asset, other security deposit is fine. Capital advance is not fine. It will be shown as other non-current assets because it is not a financial asset. You don't have a right to receive cash but to receive assets. Deferred tax assets are there. If we have a deferred tax liability, we may want to offset it with that deferred tax liability if it is under same tax laws. Current asset, trade receivable should be a part of financial asset and not shown separately. Inventory is fine. Investments are fine. Other financial assets, let's see what it is. Cash equivalent. This is okay. Other equity should be shown under equity, not under non-current liabilities. Borrowings under financial liability, long-term provisions separately. Trade payables also under financial liabilities and current tax liabilities separately. Some additional information: 8% convertible loan, 64 lakh redeemable on 31st March 2005, 4 years. It can be converted to equity shares based on 100 new shares for every 200 of loan. Equivalent loan without conversion option 10%, which means it's a compound financial instrument. Now, in compound financial instrument, we calculate the future cash flows discounted with the market rate of interest, calculate the present value. That will be lower than the value which we have raised. Difference will be treated as equity under other equity. Interest rate would be using market interest rate on the carrying amount. You booked an interest rate of 5,12,000, which is 8% of 64 lakh, which is not correct. You will calculate the revised interest rate. Additionally, book that interest cost. If there's a tax adjustment required, if tax rate is given, do that. And in the balance sheet, also show other equity. Also calculate the closing value of your liability at the end of first year, and that will be shown under financial liabilities, non-current liability. In this particular case, the loan is repayable at the end of 2005 in totality. So usually what the institute does is, in such question, it shows the complete loan under non-financial liability. However, technically a complete loan under financial liability under non-current liability. However, technically some part may be current in nature, but that they have not done. So here they have not done any kind of a current non-current classification of the financial liability component. Is that correct or not? I don't think so, but then let's just follow what the institute has done. So if you see the solution, what they've done is they will calculate the present value of the actual payments, 5,12,000 4 years plus 60 4 lakhs of loan, and this is the present value discounted using the market rates, and this difference is the equity component. And the finance cost will be 5,975,040 into 10%. You've already booked this, so additionally this will be recognized. And the loan will be shown in the balance sheet at the end of the year at the initial value of 5,975,040 plus 5,975,005 minus 5,12,000 cash outflow. So effectively your loan amount will be this, increased by 855,404, and they've shown completely under non-current liabilities. I'm just giving you the important tricks to remember in these adjustments. Recommended dividend will be just disclosed. This is a financial liability, this is a financial liability, this is not a financial liability, is not contractual, this is a financial liability. PP consists of building held for admin purpose, this is okay. Land held for capital appreciation, reclassified to investment property and not PP because capital appreciation, it will not be owner occupied property. Vehicles used for conveyance, it is okay to be treated as PP. Factory premise construction started, no depreciation charge, it is still under construction, so this will be shown as PP under development as in CWIP and not in PP, separately shown. Other current financial assets, this is financial asset. Prepaid is not a financial asset because you'll receive services in it or goods. And this is a financial asset. So we'll have to reclassify this to other current assets. Current investment consists of security, fair value through PRL, purchase 55, shown at cost, fair value 60. So recorded at 60 and book 5,000 gain in PRL because this is through FVTPL. Due within 12 months, so current. No changes in equity, so opening plus minus change 0, closing same. However, we don't have to prepare notes. TTA same authority, so net it off. Other equity only retained earning, opening given, so opening plus current year or closing you may present because question gives that information. No dividend paid and deferred tax, no impact to be given. So any gain loss changes which you have done, you don't have to give an impact for the deferred taxes. I think that was quick discussion which will kind of help you to kind of go through this big large question very, very quickly. And now we will now move on to consolidated and separate financial statements. Cool. So now let's come on to consolidated and separate financial statements. So in this particular chapter, again, consolidated financial statement, I have not included more of the comprehensive questions. This is the smaller ones which can be expected as a 5-mark kind of a question. This time expecting something different to happen in consolidation, because institutors kind of already asked most of the questions which they've already asked previous, like have been the comprehensive questions, the balance sheet, consolidated balance sheet kind of a questions, which are there in the study material, RTPs, etc. So I expect this time possibly in consolidation, either you will get a business combination related question, and if you get in consolidation, it could be of multiple subsidiaries, not chain holding, but could be direct. It could be a question which will involve some kind of a foreign subsidiary, or maybe some subsidiary plus associate kind of a question, something which could be different from the league, maybe step acquisitions and all. Those kind of questions are not there in the study material RTP MTPs, and this question bank primarily is made out of that only. So I have not included many comprehensive questions in the important list of consolidation, but I have included it for business combination. We'll quickly kind of discuss these questions and the important aspects behind them. First and foremost, I've taken some kind of questions possibly expected in 5-mark kind of a thing. Most of these questions were newly added in SM 2021 and have not yet been asked. That's why. Very quickly, this question says that there is this PQR at the top, and then it has two wholly owned subsidiaries. Both of them have this investment in XYZ, which is a subsidiary of AB, and then it has a subsidiary, another subsidiary, RST. Question says this being an intermediate holding company because it has a subsidiary and it also has a parent. In fact, one parent and one ultimate holding company. So for XYZ, the question is there. This is holding, and this is ultimate holding, and this is its subsidiary. It's saying whether it has an exemption to prepare consolidated financial statement. Now, intermediate holding companies do have exemption to prepare consolidated financial statement if conditions are met, like they are not listed. Second, their holding or ultimate holding company is presenting financial statements as per Ind AS. And third, if they have other shareholders, that means if it's not a 100% subsidiary, they have informed that we will not be preparing consolidated, and they've not received objection from it. Now, in this case, if PQR Limited is a company which is preparing financial statement as per Ind AS, then XYZ is a 100% subsidiary of PQR, because 60 plus 40 both are owned by two subsidiaries of PQR. So two subsidiaries having 100% stake in a company will be 100% subsidiary of PQR. Hence, XYZ, if it is an unlisted company and PQR is presenting financial statement, XYZ is exempted. They don't even have to consult or discuss with BC Limited the other shareholders, because here ultimate holding company ki hum 100% subsidiary. But then question says if PQR Limited was an individual and not a company, then it would not be preparing consolidated financial statement as per Ind AS. Then AB would be preparing, but I am not 100% subsidiary of AB. Then to get exemption, I'll have to communicate to BC. And if BC, the other shareholders having no objection, I may not prepare consolidated financial statement and avail that exemption. That's basically what the point is. Next, we have another question relating to sale of stake in subsidiary. Decent, good question. It says beginning of current financial year, AB Limited has 90% interest in BC. During the financial year, it sells 70% of interest in BC to PQR. So it becomes an associate or a normal investment, but is no more a subsidiary. I've lost control. It is 90 minus 70 left with 20. Now, whenever I lose control, what do? I derecognize all assets in consolidated financial statement of subsidiary, NCI, goodwill, and against that, whatever cash I have received, plus if I have retained any investment, I will recognize it at fair value. The difference goes to PR. Plus, till now, from the subsidiary, if there have been any share in OCI, which I have recognized, I would, if it is OCIR, recognized by parent and as the parent share of OCIR, recognized by parent, will be reclassified if it is OCIR to PRL, if it is OCINR to reserves. So this question has all of that. For total consideration of 56 crore. So sales consideration for 70% stake was 56 crore. And we have lost control. The date of disposal, 20% interest is 16 crore. So that is 20% fair value. So this total comes to 82 crore. Nevertheless, net assets were 60. So against that, what I have lost is 60, but then within 60 also there would be some kind of an NCI. Net asset also include debt instruments, FVOCI, on which there is an FVOCI reserve of 6 crore. So I'll have to now, this debt instrument would be obviously a part of the net asset. So this will automatically get derecognized, but I'll have to reclassify this 6 crore. So my share in the 6 crore is 5.4. So I'll have to do another entry of OCI to PRL. How much for 5.4? Net defined benefit 6 crore resulted in reserve of measurement loss of 3. So I'll have to reclassify this? No. Ind AS 19 net defined benefit liabilities are OCI NR. So this will not be reclassified, it will be transferred to reserve. So I'll have to debit my reserve because this is a loss to I'll say net defined benefit liability 2.7, which is 90%. But I've only sold 70%, but derecognition of 90% would apply and 20% would be re-recognized at fair value. Equity instrument not held for trading 10 crore irrevocable option of FEOCI. So this is also FEOCI NR. So here there was a gain of 4 crores. So again I'll have to do what? I'll have to credit my reserves. So fair value gain to reserves and not to PRL. And this will be 3.6. And foreign operation 20 crores and reserve was 8 crores. So this will be OCI R. So this will be transferred to PRL. So I'll have to book foreign exchange gain reclassified to PRL of 7.2 crores. So this will additionally happen. In consolidated financial statement of AB, 90% above reserves were included equity reserve balances, so respective places it was there, and 10% NCI included as part of carrying amount of NCI. So here NCI, whether measured at fair value or what, it is not given, so we will assume it will be identifiable net asset proportion. And second, goodwill is not given, so we will kind of, because net assets are given, we will assume goodwill is included in the 60. Nevertheless, so NCI would be measured at 10% of 60, 54. So 82 minus 54 is the profit from sale. So now they have done a combined journal entry for this after all the explanation. So this 18 is your profit from disposal and all the others are reclassification, which I just kind of explained you can go through. Next is again sale of stake. 80% I have disposed entire stake in two transactions. New question which was added in SM 2021. Which is basically with respect to the fact that when you sell your investment and you do multiple transactions to sell your investment, should these transactions be all accounted independently or as a part of one? India says that when you do multiple transactions at or about the same time under a single plan, it will be treated as one single transaction. And in this case, the question says that first we sold 25% and then we sold 55% stake. Had this not been for one transaction, first 25% sale would be treated as transaction with equity participant because I would not have lost control. And then I would have lost control. So I would have done a derecognition of subsidiary accounting. This is not going to be the case. Here what I would do is I will treat both of these are combined one transaction. So I'll say essentially total 8 lakhs I have sold my stake for total 8 lakh rupees. The question says net assets of UV and NCI were 9 and 180. So gain of 80,000 is to be recognized finally. One question would come is when do I recognize I have lost control? So if you say that this was that you've done a one contract under which there have been these sales which have happened in two tranches and the contract was done on the first date itself. So you will derecognize all the asset liability on the first day itself. 25% 250 you will receive bank debit and balance 550 you will debit as receivable. However, in the first transaction, if the control was not lost and it was lost in the second one, but it was all planned together, then first 250 would be treated as advance and then you will say I have received another 550, 250 advance will be transferred and gain would be recognized. So that is something which has been explained. Then you have another question wherein you bought 60%. So this is not one of the study material or the RTP MTP question. This is more of a warm-up question which I have given, a good practice question if you want to kind of just do it in the last moment. What all adjustments are there in this question, I'll just kind of hop on that. So on 1st May, you bought 60% by paying 76,000 cash. And it says that the balance sheet is on 30th November. So first, the acquisition has happened during the year and not beginning of the year. So you'll have to split the current year profits between pre and post. So that one adjustment is there. 1st May. So 1st May to 30th November, if we go, it'll be like 5 months is to 7 months. Pre-post. This is one adjustment. Then you have non-current assets. Investments are 98,000, whereas you invested for 76, and it does not say investment in subsidiary only. So that means there's another adjustment of other investment. So these are Hidden adjustments is what we call as in the class. Then inventory receivable cash, we'll properly present it as financial asset and all. Share capital, retained earnings, 8% loan and current liability. We'll have to see whether 8% needs any kind of a accounting treatment. Then inventory of K, which is, so parent is K and S is subsidiary. 8,000 includes 8,000 of goods purchased for cash from S. So there's no intercompany adjustment with respect to receivable payable, but yes, intercompany transfer adjustment for profits is there. That says cost plus 25% and 8,000 is the value in the books of K. So we know that 1/4 on cost will be 1/5 on selling price. So in this intercompany transfer, the unrealized profit will be 8,000 into 25 upon 125 or 1/5, which is 1,600. And who has earned this? S. So this will be reduced from profits of S. So when you prepare the analysis of profit table, Mayavi table, what we call in the class, we'll reduce it from profits of S. Here we will assume that this transaction happened after 1st of May. And we may put a note on it because acquisition has happened during the year. Then 1st June, which is after 1st of May, K transferred an item of plant 15,000 and remaining life of 5 years. So there is another intercompany transfer, but this is basically a case where sale of goods, but it is leading to purchase of PP. One good adjustment. You should practice this one as well. So in this case, we'll assume what was the cost to the group, and based on that, what should have been the value at which plant would have been recognized on 30th of November. So 15,000 is the value at which it is transferred, but carrying amount was 10,000. So we'll say 10,000 minus depreciation 5 years. So every year 2,000. June, July, August, September, October, November, 6 months. It should be 1,000 rupees. So it should be shown at 9,000. However, it is shown at 13,500. So we will reduce 4,500 from the plant and also from profits of the company who earned it. So K earned this particular profit. So we'll reduce profits of K. Not by 5,000, but by 4,500. Then K values NCI at fair value. So if there is a goodwill impairment, even NCI would bear it, and fair value is given. So NCI adjustment is there. So I'm just saying that you have these kind of multiple adjustment, intercompany transfer goods, intercompany transfer goods asset, fair value of NCI is there. Okay. Then you have impairment loss 1,000 to be charged. So goodwill will be reduced by this amount, and NCI also will get affected by it. Then S earned a profit of 9,000 year ended 30th November 2007. So here you didn't had the information about current year profit. So 9,000, you'll have to take an assumption that it is accrued evenly throughout the year. So this is also an adjustment working note which you'll have to create. Loan notes represent money borrowed from K. So it's an intercompany transfer which will fetch you definite one simple mark for it. 5,000 relating to inventory sold during the year raised a check of 2,500. So this is another intercompany transfer, but here there is a cash in transit adjustment involved. So K receivable 5,000. So we'll reduce receivable by 5,000, but we will reduce payables by 2,500, and we'll show cash in transit as a 2,500. And this is the final answer which you can get. Similar question like this has been asked in the exam, so I don't expect similar question like this to be asked once again, but then could be a little tricky, so I've included. Question says, I have a subsidiary, that subsidiary as an associate. So I have a subsidiary and that subsidiary as an associate. No. The question says, I have an associate which has a subsidiary. So it's a question of chain holding. I mean, no, it's a question where I have an associate which has a subsidiary. Now what has happened in this question is, the associate has sold some part of investment of its subsidiary. So the question is basically, I am the company A, I have an associate B, which in turn has a subsidiary C. Now B has sold some stake in C, but it has not still lost control, so it's a transaction with equity participants. The entity B recognized net asset relating to entities are 1,000 in consolidated financial statement, so equity method. B sold 20% interest in C to a third party NCI for 300 and recognized this transaction resulting in crediting equity by 100. Okay, sorry. So this is not equity method, this is entity B books. Entity B has recognized assets of C 1,000. It has sold 20%, that means 200 worth of stake, but it has got 300. It is not lost control. Hence, NCI would increase by 200, but I would get 300. So 100 would be increased in B's reserves. Transaction with equity participant, any gain which you make, you will directly go to reserve because it's a transaction with equity participant. So the question which comes is now when A consolidates with B, we will add up all post-acquisition profits of B. Amongst this post-acquisition profits, will this 100 increase in reserve be also added? Absolutely, because we will add any increase in reserves of B. So that is basically mainly what the question is all about. So you just have to do that adjustment, nothing more than that. So it says entity A also recognizes a gain of 20, which is 20% of 100. Then equity method, very common question, multiple times asked, but it does not mean it cannot be asked further because institute kind of just simply as repetitively, it kind of loves asking questions on associate JV. 1st April, 35% interest acquired in another entity XYZ and has significant influence, hence is an associate for 47,50,000. Date of acquisition, book value was 90 lakh, fair value was 110. So we will consider it as 110. Investor has determined that difference of 20 lakh is due to PP. That means there will be a depreciation effect, 2 lakh per annum. So whatever is the profit shown by associate, we'll have to further reduce it by 2 lakh per annum. Because for us, the assets are considered to be dear or expensive. I made a profit of 8 lakh. Now, XYZ made a profit of 8 lakh, which is the associate. Paid 12 lakh dividend. XYZ also has a long-term investment in equity securities. Classified as FEOCI and increase is recognized by 2 lakh in OCI. No deferred tax treatment to be done. So first and foremost, the fair value of the assets was 110. You acquired 35%, which will make it 385. You acquired it for 475, which means you will have to disclose a goodwill, but you will not have to present it in the balance sheet. Your presentation ideally then would be what? So you disclose a 9 lakh balancing figure as goodwill on the date of acquisition. And 4750 is your cost of investment. Then what is the increase which happens during the year? 8 lakh minus 2 lakh of extra depreciation. So I would say my profit share would be only on 6 lakh. 6 lakh 35% would be 210. This is that 210. Plus additionally fair value gain 35% of 2 lakh, which is 70. And dividend share would be reduced 12 lakh 35%, which will be 420. This is the carrying amount in the books. That's it. There's a question of associate to subsidiary. Automobile groups acquired 25% voting in shares by paying 4320 crore on 1419. It accounts its investment in Sean Limited using equity method as per Ind AS 20. 31st March 2020, it recognizes share of net assets in Sean using equity accounting as follows. So question says I have 25% stake which I had acquired on 1419 at this amount. I am following equity method after 1 year. These are the changes in assets which happened. So I have recognized and this is the share. So I'll increase my investment with these values and book respective places gain loss. This will go to NR, non-reclassifiable. This is reclassifiable. Now we have acquired remaining 75% for 13,500. So now it becomes a subsidiary. So it will be deemed as a derecognition of associate. And in that case, I'll have to book a gain loss on the existing 25% by comparing the carrying amount with the fair value. So what is my carrying amount? It will be 4320. Assuming initially there was no capital reserve, 378, 54 and 27. This is the carrying amount. What is the selling price deemed to be? So it says 25% fair value is 4860. The difference will go to PRL. Plus, this is already in PRL, but this will be reclassified. So we'll have to do OCI to PRL here. And here we'll have to do fair value reserve to reserves of that amount. So those entries are something which are given here. That's about it. And then you will have to recognize what? So you'll have to now, so this is one gain loss which you book, and then you'll recognize all the assets of the subsidiary and you will credit the investment total which you have made, which is 13,500 which you have paid now and 4860 the value of the investment. So if they've done one compound entry, if you do two entries, then you will be able to understand it better. Next, there is this one question which the institute added in SM 2021, not yet asked in the exam, relating to losses which are there in associate. It's a very lengthy question. So you'll have to really concentrate well to kind of understand this. Now, before I come to this, let me just kind of very quickly revise the whole concept with you. Friends, countrymen, remember, if I have a subsidiary which is making losses, my share of losses I'll reduce from my reserves. And NCI share of losses will reduce NCI. If losses are too many, NCI may also go negative. No problem with that. But here the thing is different. I am not a parent company. In fact, I am an investor. She is not. It is not my subsidiary. In fact, it's an associate. So I invested, say, 20% stake, $100, acquired 20% stake in a company, say Paytm. Now, that Paytm is making huge amount of losses. And let's say, for example, it incurred a loss of 110 rupees in the next year. My 20% share is 22 bucks. Now, please understand. I acquired the investment at 20. In first year, they made a loss of 110. 22 is my share. If I reduce 22, my investment will come to 0 or minus 2. Minus 2. Do I have a liability to pay $2? No, because these are fully paid shares. And my liability is limited to the share capital. So I simply ignore that loss of 2 rupees. Number. Next year, Paytm makes a profit of 10 rupees. My share is 2 rupees. Should I recognize it? So the logic is the cumulative loss, 110 loss, 10 profit. Cumulative loss is 100. My share is 20, my investment was 20, my asset is 0, it is still 0. I will not recognize any gain in that 10 rupees. But next year, if it makes a gain of 15 rupees, I would say last year 10 rupees loss I ignored, so current year there 10 rupees profit, I would ignore the additional 5 rupees, my share 20%, 1 rupees I will recognize my investment now at 1 rupee. Meaning, point number 1, in case of investment in associate, share in losses of associate, maximum to the extent of the investment which you have made is what you will recognize, not beyond that, unless and until you have an obligation that you have given a guarantee or a partly paid share exists and you'll have to repay, which is normally not the case in this question. So what is so typical about this question? Something beyond this is what the India says. India says, it is possible that you have not just invested in the equity capital of the subsidiary or the associate actually. You could have also taken preference shares in the associate. You may also have given a long-term loan to the associate. So India says whatever forms part of your net investment in your associate or joint venture, you will have to recognize post-acquisition losses share from all of these and not just your investment in equity. Because ultimately, even preference share, the money may actually be lost if the company is making huge losses. You should kind of book losses there itself. Even loan if you have given. However, see, if you have given a loan at market rate of interest, not just because it was your associate, but due to some other commercial reason, that will not form part of your net investment. Trade receivables, if you have from any associate, definitely does not form part of trade net investment in associate. So ideally, net investment in associate would be equity shares, preference or loan given. If they are not really given at arm's length price, but rather given because you have a significant influence or some kind of a stake, your relationship has influenced this decision. Now the problem which comes is, say I have invested 20 rupees and 20% equity shares of Paytm, and I have also given a loan to Paytm. Or in my example, 20% investment was made for 100 rupees. I have also given a loan of 100 rupees to Paytm, right? And this is not at market rate of interest, as a support I have given to. Now Paytm makes a loss of 110. In fact, it makes a loss of, okay, so let's not get too much confused on this. Investment in equity is 100 and investment as in loan given is 100. And this is representing, let's say, 20% stake. Post acquisition, my associate makes a loss. and it makes a loss of, let's say, 600. So my share in this loss is 20% as in 120. Now what do I do? My question is, this investment in equity of associate is not accounted as per Ind AS 109 because that specifically says investment in subsidiary associate JVs are accounted under Ind AS 27, not under 109, and consolidated as per 28. But loan given is a financial asset which is accounted under Ind AS 109. It is not accounted under 27. So now if I am doing accounting under 27 separate financial statement or 28 equity method, I would just adjust those things which are accounted for in this stand. Hence this 120 loss, I would adjust from 100 and I will reduce it to 0 and I'll ignore the loss of 20. But then for a fact, I know that this may affect the loan which I have given, its recoverability as well. And this is where the Ind AS specifies that any post-acquisition losses would be adjusted first from equity, then any other modes of assets, investments which you have made, which represent net investment in associate JV. What should be the sequence? So it's very simple. The one who stands last, whenever the company will do liquidation, the one who stands last in the line will be first written off because he will have the least possibility to get the money. So it's like when the company winds off, goes for winding off, who would be the last person to receive money? Equity shareholders. So they'll be first written off. Then preference shareholders. So they'll be written off after equity shareholders. Then maybe unsecured loans. So that will come next. So if there were three things here, equity shares, preference shares, and let's say loan, I would first write off loss from equity share, then from preference share, then from loan. Then if it makes a profit, I would first increase my, so if it makes money, first whom will I repay? The one who's standing in front of the line. So first I will increase the loan, then preference shares, and then equity. However, because here the loan given is also accounted under 109, standard says you will do first accounting under respective standard and then you will do this accounting of allocation of loss. So in this particular question, what has happened now? Let's come to the question. It says it has made three type of investments in associate: equity share 25%, preference share non-cumulative, which is forming part of net investment in associate and is measured at fair value as per 109. So it is followed or 109 applies on it. And then we have long-term loan, 10% per annum interest received at the end of each year. And it is also accounted on 109, but it also forms part of net investment in associate. So losses could be adjusted from all three of them. Start of year one, the carrying value is given to be blah, blah, blah. And the table summarizes the changes in the fair value as well as the impairment loss on the loan as well as the profit or loss on associate. So first and foremost, these are 109 changes for preference share, 109 changes for loan. We will first adjust these changes and then we'll go to the other loss allocation. And the first year loss is 16 lakh. And this is entity share. Now, how do I do? So what I'll do is 5 lakh preference share minus 50,000 fair value change. So my preference share here would otherwise go to 450 as per 109. Loan 50,000 impairment loss. So as per 109, it will otherwise go to 250. And 16 lakh rupees of loss. So equity investment in equity, 10 lakh minus 10 lakh will come to 0. I still have left 6 lakh of loss. First, I would reduce 4.5 from here because they are standing behind loan providers. The balance 1.5 I'll book from here. So this will be at 1 lakh and this will be at nil. So first year, this is going to be my loss allocation. Finally, I'll just have 1 lakh rupees of long-term loan. Now, second year, what happens? There's another 50,000 rupees of loss which happens in preference share. I have to do accounting first under 109, but my preference share are already 0. So I'll have to recoup that particular loss. So I'll have to add back the loss of 50,000 which I recognized in the last year so that I can recognize this 50,000 of loss as per 109 and bring it back once to nil. So this 50,000, where do I add back from? So I'll have only asset to adjust it from. Which asset? Loan asset. So my loan asset So I will say that not by mistake, but I had allocated a higher loss, which I should not have allocated because I have to book a loss of this particular thing. So I'll reallocate this loss to loan because it still has that particular value. So in the second year, I will book a 50,000 loss here, but there's another 2 lakh rupees of loss. So I can maximum coop 50,000. So I'll have to ignore 1.5 lakh of loss in this year. Now future years, when I get a gain of 1.5 lakh, I'll have to ignore that as well. So next year, everything would come effectively at zero. And I'll just book a loss of how much? So 50,000 would be reclassified. Additionally, loss which will be recognized. So 50,000 loss here would be recognized, and additionally 50,000 share of loss would be recognized. This is the way it is presented here. Now let's come to third year. Thankfully, third year the value increases. So this goes plus 1 lakh. And in third year, this also gets increased by 50,000. But there's no loss. Now see, last year you had ignored a loss of 1.5 lakh. Now you have two investments where you can adjust this loss. You'll have to book a loss of 1 lakh here and 50k here. So that means we'll book a gain of 1 lakh in preference share, 50,000, reversal of impairment loss in loan assets, and then the loss which we had ignored in the last year, we'll have to book that. Still all my assets would come at zero. But I'll have to do adjustment on 109 gain and then adjustment of Ind AS 28 loss. Now next year again 50,000 plus, so this will come at 50k. Here there's no gain, so this will be at zero opening values. Now there's a gain of 10 lakh. First, whom should I go to? The one who's standing in the front of the line, that means the loan asset. Now loan asset ideally would have been recognized at what? So it was at 3 lakh, we recognized the loss of 50 as per 109 and recovered it at 50, so it should come at 3 lakh. So we'll book a gain of 3 lakh first year. So then 7 lakh go to preference shares, but then preference shares ideally should have been at what value? Had there been no loss of Ind AS 28, the value would have been what? 5 minus 50 minus 54 plus 1, 5 plus 50 which I've just booked now. So 5 lakh is what I can recover here, what I've recognized as loss. So I've already recovered this much, so 2 lakh will go to equity. So fourth year, if you see the table, you will find this. 2 lakh equity, 3 lakh goes to long-term loan, and preference share will be at 550, which will be 50 from 109 and 5 lakh due to Ind AS 20. And then the last year, whatever gain you make will be all part of equity investment because you've already kind of recovered everything in preference and loan. And here there's a 30,000 gain on 109. So your investment in preference share capital will be now at 580, but as per 109. Your loan would be just at 3 lakhs, amortized cost method maybe, and 10 lakh would be added here, and this will be 12. Wonderful. Now there's this another question which is given in RTP December 21, very strange question. In fact, strange answer, but a different question. Definitely do it. Don't expect this to come in the exam, but still. Question says, I was an investment entity and parent of Praja Limited. Wow, Raja nahi, PP Limited was parent of Praja Limited. Investment in Praja is carried in separate financial statement at fair value through OCI. Now this is FVOCI and this is investment in equity share. That means it should be OCI R. And this is where the problem is. Now next year beginning it becomes investment entity. So when a non-investment entity classifies to be an investment entity, all its investment are then recognized at fair value, gain loss transferred to PRL. What is the gain loss? The fair value minus the carrying amount. So it says carrying amount of investment was 8 lakh and fair value is 10 lakh. So 2 lakh will go to PRL. But it says that 8 lakh rupees is the current carrying amount. It is not the cost. It says PP has recognized OCI of 1 lakh as previous fair value increase. So in separate financial statement, this was a non-investment entity. Non-investment entity in separate financial statement can measure its investment at cost or fair value, and fair value also OCI or PRL. But OCI has to be OCI and R because it is equity investment. So they had followed in Ind AS 27 para 10 option to measure the investment by the non-investment entity in its subsidiary Praja Limited at FVOCI, and they have already recognized a gain of 1 lakh. Now that 1 lakh rupees should be transferred because it was OCI NR. But what they have done is they have reclassified to PRL, which is strange. But we will still do this, what they have done. So they have reclassified a gain of 3 lakh rupees. In total gain of 3 lakh they have booked. 1 lakh they have reclassified to PRL. 2 lakh they have booked it now. As per Ind AS 27, when a non-investment entity classifies to be an investment entity, it has to book the investment at fair value and recognize gain or loss to PRL, and also transfer or reclassify the already recognized gain or losses. They have reclassified it to PRL, whereas in my opinion it is OCI NR, so maybe should have gone to reserves. But if the question comes in the exam, just do what the institute has done and maybe put a note on it. So that's about it basically with respect to consolidation. And we have business combination. A lot of questions of business combinations is what I have added here. And most of these questions are a little offbeat questions, not the regular ones, the consolidation ones, parent subsidiary ones. Something relating to reconstruction, something relating to sale of divisions or demerger, or ones relating to reverse acquisition. Those kind of offbeat and different questions is what I have kind of incorporated. I'll do a very quick discussion of these particular questions and then we'll close the session here. Thereafter, the remaining set of standards you can give in your inputs in terms of, is this something fine, this is something more or less is what you want. And then accordingly, I can share it maybe in the Fast app or on YouTube as you kind of suggest and we kind of decide. Business combination question number 1, sale of division. What has happened is company has 2 division, laptop and mobile. 31st March 2002 extract is given. Mobile division was sold to 25 crores to turn around. A new company who allotted 1 crore equity share of 10 each at a premium of 15 per share, which is 25 crore the sales consideration. What is most important in this question is it was given to the members of enterprise limited. So it is actually a case of sale of division. Whenever you do a sale of division, what you will do is you will transfer all the assets and liability, and whatever you get, difference will go to PRL. As again. But if the consideration is not given to you but given to the members, then in that particular case, you will have to debit your reserves because it will be treated as distribution of profit. This is something of demerger. So in this particular case, since the consideration is given to members, what we simply do is mobile division assets, we will credit, which is 100 and 100. So, okay, 100 and 100. And then loan funds we will debit 300. So effectively it is minus 100 and we've got 25. So effectively what we will have to do is we will have to possibly book a gain of 125. But then that 25 is not coming to me altogether. It is going to members directly. So what the institute does is simply, it says that net this particular division, if you see, had a negative net worth of 100, negative net assets of 100, which have gone. So that is the gain which you have made. This will go to capital reserves. This will not go to PRL because it is given to the members. Cool. So this is the way you will have to do the entries, and then they have asked you to do journal entries and prepare financial statements of both the entities. So you will have to prepare the financial statement like that. Now in this particular case, the new company is Turnaround Limited. In the new company Turnaround Limited, now what happens is, will the assets be recognized at fair values? The answer is no, because ultimately the control lies with the same set of company because you have transferred it and the shares are given to the members of my company. So the owners of Turnaround are also the owners of the existing company. So it is actually a case of demerger where you do not use any fair value, and that is why the shares are also recognized at nominal value, because demerger says because there is no change in control, the consideration will be recognized at face values and not at fair values, and that is why we have not recognized any security premium of 15 crores. Rather, what we have done is we have got a net liability or net assets are minus 100 and we have paid 110 additionally. So we will have to create a negative reserve of 110. This is not definitely a security premium, it's just a negative reserve of 110. This is the way you will have to present it. Very standard reverse acquisition question already asked in the exam. Just remember one thing in the reverse acquisition question. How do we identify questions of reverse acquisition? So whenever the question says that consideration is given in form of equity shares, check the legal acquirer, the one who is buying the other company, whether the number of shares issued are more than its own share capital or number of shares with the company. If that is the case, it will be a case of reverse acquisition. In this particular example, A issues 2.5 shares in exchange of 1 share of B. B has 60 shares. That means against this 60 shares, I would have issued 150 shares of A. A already has only 100 shares, which means it has issued more than its existing number of shares. That means the reverse acquisition. In reverse acquisition, then what happens is all assets and liabilities of the accounting acquirer, the legal acquirer, will be taken at carrying amount. My assets and liabilities will be taken at fair value. What is most important is PC. How do we calculate the PC? We will say had B acquired A, what it would have given to A. So A had 100 shares. Now B is getting 2.5 share for every share of A. So if B would have acquired A, it would have given 1 share against its 2.5 share. That means we would have given him 40 shares. So we will say that PC for acquiring A, legally A has acquired B, but in substance B has acquired A. And what it has given in return, so we will assume that B would have given 40 of its own shares. What is the worth of 1 share of B? It is 40. So 40 shares into 40, 1600 is the PC. Against which, what are the net assets of A? Difference would be goodwill. Books goodwill shown would be of A, not of B. A very good question, do it very well. In this question, there are two possibilities which they have created. They say AX and BX amalgamated to 1st January 2002 to form a new company, ABX. Remember, under NDS, A plus B is equal to C usually would lead to, unless it's a joint arrangement, would lead to reverse acquisition. Because see, if A plus B is equal to C, C would have issued its shares to owners of A and B. If both of them have got equal shares, it's a joint arrangement, 103 does not apply. But if that is not the case, one would get majority of shares, as in more shares than the other. And that will be treated as the accounting acquirer. All the assets and liability of that company would be at carrying amounts, and of the other company would be at fair value. Goodwill also would be only of the other company. So now this is not a concept revision class, but in this case, let's see what has happened. So AX, BX are two companies. These are all the assets and liabilities which are given. Very quickly, we'll read through PP, investment, inventory, trade receivable, cash and bank equity, other equity, financial liability, borrowing, trade payables. Other equity, they have these kind of reserves. Earlier, these used to create amalgamation adjustment account for statutory reserves. Nothing like that happens in NDAs. ABX acquires requisite, so NDAs does not prohibit that as well, but nothing specifically mentioned. ABX issued requisite number of shares to discharge the claim of equity shareholder of transferor company. It's a very tricky thing. Please remember, we in the class do a discussion on the various possibilities which can come in such questions. I'm just kind of quickly repeating it here. One, when you say A plus B forms C, and nothing is given with respect to PC, simply whatever is the share capital of A and whatever is the share capital of B, you just issue that. But if it says C is formed with a total capital of X, then you divide that X in ratio of the share capital of A and B. But in case if the question says that we are issuing requisite number of shares and total capital of C is defined, then requisite number of shares you will give shares of C to shareholders of A and B in requisite number, and requisite number means in proportion of their intrinsic value, net asset value, fair values, and not in ratio of share capital. A strange question could be, it says requisite number shares are issued to A and B by C and does not say what is the total capital of C. Then you will have to assume that the total capital of C is equal to the sum total of individual capital of A and B, which is this case. So it says requisite number of shares are given to transferor company. I'm not repeating things because this is a revision. You can always kind of rewind and replay and listen to what I've said. But what I've said, each and every word has been carefully drafted and said, and it's absolutely perfect. New debentures were issued for old. You have to show a note showing PC and discharge. Assuming both entities are under common controls, it's a common control transaction, so no goodwill gets recognized. And then assuming BX is a larger entity and they'll take control of ABX. So it's a reverse acquisition where we will recognize goodwill of AX and not of BX. We've been given with fair value of both the sum assets and the total business. Now requisite number would mean 11:40. What will be the total PC? Because the question does not specify what will be the total capital of ABX, so we will assume it will be 6 plus 7, 13,000. We'll have to allocate 13,000 in ratio of, because it's a requisite number, you'll have to allocate it in the ratio of 11:40. So what it says is total PC is 13,000. It will be allocated in ratio of net assets proportion value. And in this particular case, okay, so I am first basically talking about the second case. So in the second case, 11,000 and 14,000 is the what? So basically that is the ratio which we'll use to allocate or decide what are the number of shares to be issued. In fact, and that will also become my PC in that case. So in second case, PC would be 11,000. That is the fair value of shares. And then I'll calculate what is the net asset value which I've got, and difference will be then recognized as goodwill. Now let's come to the first case, which is a common control transaction. Now in case of common control transaction, what we do essentially is, so here fair value would be calculated not using the fair value of assets and liability because we don't consider that. Then we will do fair value basically of capital plus reserve, which is net assets at carrying amount. Now net asset at carrying amount is asset minus liability or capital plus reserves. So it will be 9050 and 9700. So 13,000 will be divided in the ratio of 9050 and 9700. And this is the number of shares which you will issue to AX and BX under common control transaction. And in the balance sheet, what happens in case of common control transaction? Nothing happens. Everything is just a line by line consolidation. Just everything will be total because this is 13,000. So just total. There's just a working note as to who gets what. Otherwise, the ABX balance sheet is just a sum total of each thing individually. No fair values considered because common control transaction we ignore fair values. Appendix C 103 applies. But if BX is larger entity, then AX limited assets would be taken at fair values. Goodwill of AX also, if it comes, will have to be recognized. You can see, common control, your assets would come at 16,000. As an example, I can just show you here, it will be 16,000. But when it is actually not a common control, but acquisition of control by one over the other, see PP of AX is 9,500 fair value. It will be recognized at 9,500. So total will be 17,000. We'll increase that by 1,000. You can see in the second case, your PP would be 9,500 added. But PP of BX, because that is the controlling entity, will be at carrying amount the same value. And thus goodwill also would refer only to AX. Cool. That's about it. Cool. Then you have another question which I've just included. You may get as a 5-mark question because there was an amendment which happened in various amendment rules 2020 and no question was asked relating to this in July 21 exams. So they may ask this because it relates to an amendment, asset concentration test. Under a business combination transaction, what happens is you have the choice to apply an asset concentration test, and if you can prove that a set or similar set of asset constitute 90% or more of the total value, gross value of asset, you can prove that it is not a business combination and 103 would not apply. Asset acquisition accounting will apply and not business acquisition. Now, in order to calculate this, what you have to do is you have to basically take what is the value of that single asset where the whole value is concentrated upon dividing it by the gross value of asset. How do we calculate the gross value of asset? We have two methods for doing that. In one method, I have to calculate goodwill, which is a more trickier method, so I prefer to use the other method. In the other method, what I do is I simply say gross value of asset is nothing but the PC which I have paid plus the NCI. This is the total value plus all the liabilities which I have taken because gross value of asset, PC plus NCI is nothing but net asset plus goodwill. So if I add liabilities to it, I will get basically instead of net assets, total assets. So I'll add all my liabilities. However, I have to exclude cash balance and any kind of deferred tax assets or deferred tax liabilities for it. So in this particular case, what we will do is gross value of asset is what you have to all calculate, which will be 1,000. So we calculate it basically from the PC side. So what it says is I have 20% stake and acquires another 50% stake by paying 300 crores. The fair value of asset acquired and liabilities are given to be as follows. Fair value of entity B is 400 crores and NCI is 120 crores. Previously held interest is 80 crores. So from the PC side, if I do, what I have done is 300 is the PC which I have paid for 50%. My existing 20% have a value of 80 and NCI of 30% has a value of 120. Liabilities which I have taken, excluding DTL, I'll add at 800. DTA is to be excluded. There's no DTA. Cash and cash equivalents are to be excluded. So this would come to 500, 300, 1100. So gross value of asset is 1100. Major asset is building, which is 1000. This is more than 90%. Hence, asset concentration test is met, and it is asset acquisition and not business acquisition. This is the simplest way of doing it. Cool. Okay, now we have another question. This is basically, this was asked in the RTP of December 21. It's a very new question. Please do it. Not to say that it is expected in the exam, but then if it comes in the exam, it is very easy to be solved provided you have done it once. I'm not reading the whole question, just telling you what has happened in this case. X, Y, and Z, three companies have jointly taken some extraction block and are under a joint arrangement managing that. Now, within this, one of the joint operator is withdrawing and is selling its stake to the other joint operators. Ind AS 103 specifically says that in a joint arrangement, when one of the joint operators acquire any other stake in the joint arrangement, if the joint arrangement as a whole is a business, then this acquisition of stake will also be treated as a business acquisition. Even if that part of the business which you have acquired is not a new business or an independent business itself, and you are already one of the joint operators. So essentially speaking, if ABC are three joint operators or XYZ are three joint operators and Y sells its stake to X, definitely X would pay a lump sum money to it, against which all the assets and liabilities of Y would come to X. There could be a difference between the PC paid and the net assets acquired. That difference would be treated as goodwill, and all the assets and liability of Y would be recognized at fair value. Nothing of Ind AS 28. Remember, nothing of Ind AS 28 would apply on this, despite the fact that they have strangely given reference to Ind AS 28, because this is actually a question of joint arrangement in the nature of joint operations and not a joint venture. Equity method does not apply here. It is basically a method wherein we are kind of acquiring assets of the other entity. Any which ways, I would rather say 111 applies here. So based on that, they have given this particular situation. They have created a whole lot of story, and finally they have said that company X is paying 1 lakh and acquiring 33.33% of PI rights owned by company Z. And they have said that after signing the agreement, we have approached the government for approval, and we have got this approval on 30th of June. Excuse me. So 30th June is basically the date of approval, hence the date of acquisition of control, because it is essential for the industry. So you will consider 30th June fair values of Z. You will take 33.33%. Do not do 1/3, because 1/3 of 3 lakh would be 1 lakh, but 30.33% will be 99990, and in fact 4 times 9 and 0, and that is what the institute has done. Calculate the net identifiable asset minus PC, and difference would be treated as goodwill. This is the way you'll have to solve it. That's the only special thing about this question. Very lengthy and daravna, intimidating question it is. One of my favorite questions of business combination. Again, very lengthy to be asked in exam. Could be a part of it may be asked in the exams. But a very good practice question, helps you to kind of refine a lot of concepts. Very quickly, I'll just tell you the adjustments which are there. In 2 tranches, separate tranches, you have acquired investment in S, first 15% on November 6 and 45% on 1st January. This is the date of acquisition of control. Based on the above mentioned companies, rupees are their functional currency. They have acquired control on 1st January, and this is the balance sheet on that date. So same date balance sheet is given to you. Now, it is actually not a question of acquisition of company, but acquisition of shares. So still consolidation applies. But then the question has majority of the adjustments, which we normally study under business combination chapter 103, because they relate to more or less the exceptions. So one thing is clear, when you have to calculate goodwill, you will take a fair value of this 15%, 45%, whatever cost which you have paid, and NCI add fair value or a proportionate share in net identifiable assets and compare it with net identifiable assets using the fair values given, which is given here. PP fair value would be this, intangible would be this, investment would be this. Inventories would be this, trade receivable would be this, other current asset. Non-current asset held for sale. This is fair value. We will not take this because there is an exception which says non-current asset held for sale acquired will be measured at net fair value, which is fair value less direct selling cost and not fair value. So some information will be given for that. We are not concerned with this. Then borrowings will take at 20, trade payables at this, provision for liability, current tax liability. Then it says PP balance sheet, leasehold motor vehicles have fair carrying amount of 1 and fair value of 1.2. So we'll take 1.2. There's this lease related adjustment which is there, which should ideally have been excluded because of the very simple reason that now 116 has come into picture because 116 has changed the whole paradigm of accounting. However, they've not changed the answer or updated the answer accordingly. So it says date of inception, 1st April, inception. S Limited has classified the lease as finance lease. But if we see the circumstances today, it will be an operating lease. We will simply say that you've classified it as finance lease. The classification is not rechecked that exists even today. 103 specifically says that when you acquire a company, you classify all the assets and liability from parent's point of view. However, insurance contract and lease agreements are not reclassified on the date of acquisition. They are accounted for with the same classification which was done earlier. This was relevant in the earlier days because if the lessee could have classified a lease as finance and operating lease, but under the new standard, every lease is a finance lease. Nevertheless, in this case, otherwise lessee has classified it as finance lease and we continue to classify it as finance lease, so there's no problem per se whatsoever. Then contingent liability of S Limited are given. Lawsuit filed by customer 2 crore fair value, so we'll consider fair value. Even if it is not probable, but there is an exception. Normally, we do not recognize liabilities in the books which are not probable to be paid and only disclose it as contingent liability. But under business combination, even contingent liabilities are recognized in books at a fair value. So you'll have to recognize it at fair value. Income tax demand 7 crore raised by authority. 2 crore is the fair value. It is not probable. Still, you'll have to recognize. So 2.5 crores. You'll have to additionally recognize as liability and reduce your net identifiable assets. In this question, you also have to give deferred tax impact for each and every difference and adjustment. So this will not have any kind of a deferred tax impact because this itself relates to tax. This may have a deferred tax impact. Let's see what question says about it. It says we also have an indemnification asset maximum up to 1 crore. So since you have an indemnification asset, 1 crore represent the acquisition date fair value of indemnification. So you can recognize that indemnification asset also. This will also have a deferred tax impact, but let's see what question says. It says any amount received with respect to this above shall not be taxable. So that means indemnification asset will not have a deferred tax impact. Tax base and liability are equal to carrying values as recognized in the balance sheet. So existing carrying amount and tax base are same. So you will have to only create a deferred tax for the difference now. So here you are increasing it by 50. So this will be a taxable temporary difference. Accordingly, here you are increasing it by 10. So there will be a taxable temporary difference. You will have to create a DTA detail for it. Non-current assets held for sale 4 crore. Fair value less cost to sell is also 4 crore. So carrying amount is fair value less cost to sell. So we will recognize it at 4 and not 4.5. So there will be no deferred tax because there is no difference in carrying amount and fair value. Additional stake purchased on 1st January, it had issued to selling shareholder equity share 2 shares for every share held, which will not lead to reverse acquisition because we don't have information about the parent company. So we are assuming that and fair value is given. So this will be, all this is basically our calculation of PC. So in this PC involves issue of own shares. It involves giving cash. It also involves giving contingent consideration. Now remember one thing, if there is a contingent consideration under PC, which is in fixed equity shares, then you do not remeasure it later on. Whatever is the fair value given at the time of acquisition will be the basic value at which it will be recorded later on also. There will be no remeasurement involved. This is what the question is. Then you are being given with some values which will be helpful for calculation of NCI. Then says 31st May, which is after the date of acquisition, we learned that certain customer relationship which existed on 1st January, which met the recognition criteria also were not considered. So this will be treated as what? An adjustment. During the measurement period, you identify something, you have to correct it. So because you've already recognized goodwill on 31st March, and then you get to know about this, you will have to retrospectively with restatement change your goodwill and the value of assets. Fair value on the date of relationship at date of acquisition 1st January is 3.5 crore. and assume there is no deferred tax impact on this. So we will consider it at 3.5 crore. Then it says there are some additional relationship which have developed, which has increased to 4 crore. We will ignore this because we need fair value on the date of acquisition. 31st December 2007, end of measurement period. We have obtained all information. There are no related party. Tax rate will help you to determine your DTA, DTL. Goodwill and bargain purchase gain is to be calculated using proportionate share for NCI, PSNA. You have to also say what changes will happen post 31st March due to change in your contingent consideration. So that is something to be ignored if it is in fixed value of equity share and due to change in that customer relationship which you have identified. And contingent consideration, what will be the impact? So I'll just read out the contingent consideration thing. It says we'll pay 30 crore to selling shareholder if return on equity of S Limited is more than 25% per annum. We estimate fair value of this obligation on 1st January and 31st March as 22 and 23 crore. So this is not fixed number of equity share, it's a liability. Number one, 22 crore will be part of PC. But then subsequent changes due to not change in estimate or events existing on the date of acquisition, but due to later changes. So this 1 crore will be debited to PRL and it will not be adjusted from PC or goodwill. So contingent consideration, if it is in form of cash to be paid, will be treated as a financial liability measured at FVTPL, fair value, and gain loss transferred to PRL will not affect your PC. So this is the individual adjustment which I have explained, and then you have the consolidated complete answer for it, which you can go through. Perfect. So I've done all the major chapters and questions. I hope the Super 100 kind of concept which you had created, this kind of a discussion would help you. You have any kind of things and something, you can put it up in the notes. You need anything more, you can put it up there. You need any kind of a doubt session discussion separately, let me know. We can put it, try to plan it on YouTube or offline through Google Meet or something. Thank you very much for this, and comments once I receive on this, based on that we will plan it for the second part. Thank you.